Good afternoon, all of you.
Good afternoon, ma'am.
Good afternoon, ma'am.
So let us start where we left yesterday. Uh, so we saw insurance is classified into two major categories. One is life insurance, which means human life, and the other insurance, known as general insurance or non-life, covers everything else. So when you insure your automobiles, it is general insurance. If you have any kind of health insurance, that is also a non-life insurance. uh, when people travel, they take travel insurance, again non-life insurance, right? So that is how it is done. So yeah, so type of insurance can be auto insurance, which is very very common, or anybody who owns a two-wheeler or a automobile uh, will need it, and it is it is mandatory for everyone who's driving or is on the road to have an insurance. Yeah, so auto insurance, it protects the policyholder against financial loss in event of an incident involving a vehicle they own. Then health insurance, very very common now, especially people have used a lot of health insurance, uh, which cover the cost of medical treatment, and it is almost an essential kind of insurance. Dental insurance, your health insurance actually usually doesn't cover your dental treatment, but you can also take dental insurance, which is not very common in India. Uh, medical insurance, which protects policyholders for dental cost. So your health insurance does not cover your dental cost. If you have to take dental cost, then you have to take another insurance known as dental insurance. Okay. Now these were a non-life insurance. Then we have life insurance. As I've been telling you, life insurance covers human life. So it provides a monetary benefit to a descendant family or other resigned beneficiary. It may specifically provide for income to an insured person's family, burial, funeral, and other final expenses. These policies often allow the option of having the proceeds paid to the beneficiary, either in lump sum cash payment or an annuity. So annuity we had understood yesterday, it is equal payment. In most states, a person cannot purchase a policy on another person without their knowledge. So this also explained there has to be a insurable interest for somebody to take an insurance. So insurance basically is a policy or is a product required for uh, taking care of the risk of uncertainty of death. However, in today's time, people find it an expense. People find it a wastage of money. So in today's time, a lot of insurance also come with investment benefits. We're going to understand more about it. But the insurance started with actually paying the money only in case of death, but because people were not very keen to buy such kind of products, so a lot of insurance policies in today's time also cover investment. So for example, your parents would have LIC, or so they say, I have an LIC and I will get 2 lakhs back from it. So that those kind of insurance also have an investment component. So it's not necessary for the person to die to get some benefit out of it. Okay, so that is life insurance. Then property insurance. Property insurance is a kind of general insurance. It provides protection against risks to property, such as fire, theft, or weather damage. This may include specialized forms of insurance, such as fire insurance, flood insurance, earthquake, home insurance, inland marine insurance, or boiler insurance. So this is also a risk, somebody's gone out and there's a burglary at his place. Obviously, he will lose money, he will have a loss. And there are insurance which can take care of that. And one example which I was giving you is like when you travel, especially if it is an international travel, it's a good idea to buy insurance, because in case you miss your flight or you lose your luggage, it will cause a lot of inconvenience and obviously financial loss as well. So you can buy travel insurance to cover all those kind of losses. So property insurance, it provides protection against risks to property such as fire, theft, or weather damage. This may include specialized form of insurance such as fire insurance, flood insurance, earthquake insurance, home insurance, inland marine insurance, or boilers insurance. So we know a lot of international trade happens by sea, you know. So those kind of vehicles or vessels are also insured. And people also take insurance for offices or factories or workplaces. Yeah? So insurance is basically a product to make good your loss. Now, as I was telling you, in today's time, life insurance is also sold with an investment component. So the unit linked insurance provides the benefit of investment as well as insurance. That means in case the policyholder dies before the maturity period, his family will get his insurance amount. Even if he doesn't die, he will get some money out of the corpus which is made with the investment component of insurance. So if you look at so now insurance, you have a premium which is paid to the insurer to insure, right? Now, in case the event does not happen, the insurer is not going to return any money. However, ULIP along with the premium, in the premium, it has two components. One is the insurance component and the other is the investment component. Now, this investment component is invested in the market. Just like you didn't do investment personally, same way this investment component is invested. And obviously, when the returns are generated, it is returned to the insured. So ULIP is a kind of insurance plus investment option where you can take the benefit of both investment and insurance. Yeah, so it provides primary protection along with opportunity to earn higher return linked to the market. And it's a very, very popular product sold by the bank because it is giving dual benefit. It is at one hand providing insurance. On the other hand, it is also providing an investment opportunity. And obviously, the fund is managed by professionals, so it generates better returns than the investments done on yourself by yourself. So performance of the underlying fund with beats inflation. So it's a very flexible product. Unit-linked insurance is a very flexible product. It gives you options for premium payment. Then you also have choices of investment funds. Now, what are the choices for investments? What can you choose for your investments?
Either we invest in equity or in money market, on government bonds. We have different options of investment.
Correct. So government banks, obviously not government banks is in terms of shares you can buy, but not fixed deposit, but you have the option to invest in fixed income instruments or government securities or equity.
Yes,
depending on your risk profile. You can also choose a hybrid type of investment. You have
Yes.
a lot of choice of investment in fund. And obviously, they meet the purpose of insurance, which is risk cover. They give flexibility to the customer or the insured for top-ups and withdrawals. Top-ups means you can add more money. Withdrawal will mean you can withdraw money. In case of emergency, you can withdraw. What happened? Hari Prasad has gone. He's joined in and he gone. Went. And here what happens? The fund manager manages your investment. Yeah. So your fund is professionally managed. So this is one advantage of ULIP, where instead of you investing, you might not have so much of idea about the investment, but here a professional fund manager is doing the investment on your behalf, and therefore the fund is better managed. And obviously insurance is a long-term product, so perspective of fund manager is long-term. And what is the return, the relationship between return and tenure?
There's inverse relation between return and tenure.
That means,
Long-term return, long tenure gives higher return.
so it's a direct relationship, no?
Oh, sorry.
Yeah, ma'am. Direct.
It's a direct relationship.
Yes, I'm sorry.
So direct relationship between the time you stay invested and the return you get. So here the returns are good because perspective of fund manager is long term. It is a regular and disciplined payment. Policyholder benefits from long term view and rupee cost averaging. So here yesterday we were speaking about what to do, where should we invest in equity or fixed instrument, or should we buy insurance? You can take both. You can take the advantage of both. You can buy ULIP, where you are getting the advantage of insurance plus you are getting the advantage of investment. Obviously the premium is high because apart from insurance, they also cover investment. So the premiums are high for this kind of policies, but you also can earn good returns in investing in ULIPs. So is a pool of money. We have seen insurance itself is a pool of money. Is investment made on behalf of large number of people. It's a diversified portfolio of securities, has the fund manager who takes investment decision, right? So who is an investment manager, or what do you think about, what do you understand about an investment manager?
The managers who make the investment.
Yeah, he makes the investment decisions,
Yes, ma'am.
buy which security to invest. So he's the one who makes the investment decision. Obviously, this person is a qualified person. So you guys can also become investment managers if you want. If you want, you can become investment managers. Obviously, you'll have to study a little more. You'll have to do your CFA or your MBA finance from a good institute or your CA. But if you guys want, you can become investment managers. It is not like when you work in a bank, you are not an investment manager. In that case, you're an investment advisor. So an advisor gives advice on where to invest, whereas an investment manager actually invests, right? So if you want to go into that field, that is also a very interesting field. And if you've seen Zindagi Na Milegi Dobara, and Hrithik Roshan is an investment manager there, if you remember that movie. Okay. So that is a very good field, very, glamorous field as well. So if you want to be there, you will have to study a little more, but you can think about it. Anyways, so here, what happens? The insurance company gets the money from the people and then invest it. Okay. And obviously, when the money is invested for the insurance company, also it is generating return. So in case some people die, they'll have to just their fund value would have anyways increased, right? So that is a ULIP. So ULIP is a pool of money investment made on behalf of large number of people. And we had seen about insurance also. Insurance is dependent on large number of people. Investment made in specified class of assets. So we have seen that the investor has the choice to choose where the investment should be done. Also, the investment advisor can suggest, so depending on the risk profile of the investor, the investment advisor can suggest what kind of fund he should invest in or what class of asset he should choose. So what are the different kinds of asset classes?
Current asset and fixed asset. And
Oh, no.
We are talking
I
about.
think, ma'am,
okay,
there are 5 classes, but I don't remember what are the things added in different classes.
ma'am, in what terms? Assets in what terms?
Financial assets.
Financial assets. Okay, ma'am.
Yeah. What are the different asset classes in financial assets? You guys know, but you're not able to relate.
Financial assets. Deposits. Ma'am, give just a hint.
No one?
Ma'am, please
What are
give
different asset classes?
fixed asset.
Fixed income instruments, equity,
Yes, ma'am.
derivatives, precious metal. These are all asset classes.
Yes, ma'am.
Okay. So again, the
Ma'am?
fund manager. Yeah.
Ma'am, I have read class A, class B, class C, class D, and class E. What are these types?
Class A, class B. I don't know. I do only know about asset types as E, C, G.
Ma'am, there was a question in our assessment semester.
What was the question?
Ma'am, assets were nominated, and we have to find that in which class this relates.
No. See, when you're talking about a manufacturing company, obviously assets will be different. You'll have fixed assets and current assets there. But we are talking about here, what we are talking about are financial assets. Here we are talking about only financial assets.
Okay, ma'am.
So financial assets can be equity, fixed income instruments, derivatives, cash, fixed deposit. All these are your financial assets. So I don't know what classification you're talking about, but obviously financial assets are different, will be classified differently than your fixed assets. Financial assets mainly are current assets.
Okay,
so the money in you which you invest in money market is your financial asset. Okay. So we are specifically talking about investment assets. We are not talking about fixed assets or current assets in terms of a manufacturing company. Okay. So the fundamental is simple. The insurance company collects some money from all the insurance insured and invests that money in the market. In case the person does not die, the investment component is returned to the investor. So these are the asset classes: cash, equity, debt, even precious metal. However, in India, fund managers do not invest in gold. Insurance fund managers do not invest in gold, but precious metal can also be an asset class. So obviously, these are all market-linked securities. So I hope all of you understand market-linked securities. What are market-linked securities?
The securities which are linked to the equity market.
Not necessarily
or money market.
Yeah, money market also.
Yeah, for both markets.
Yeah, both markets.
Capital and money market.
Yeah.
Yes, ma'am.
So here, obviously, the fund value will increase when the market goes up. These are all market linked. And value of the fund decreases when the market goes out. These kind of policies obviously have a very high market risk because they invest in assets which have market risk, which are dependent on the market. So they are called unit linked because the investors are or the insureds are allotted certain unit. Unit, as we understand, is a smaller portion or a fraction. So unit is a slice or a fraction of the fund of a small denomination in equal size. It is an expression of ownership of an investor in the fund of the investors who have pooled their money into the fund. And has the same characteristics as that of the fund. So we'll understand unit more in detail when we look at the mutual fund, but basically unit will represent how much portion of the fund the the
We invest
account
in
holder.
regular times.
Yeah. So for example, I bought something for 100 rupees, right? As of now, I have 1 unit of 100 rupees, but the market would change, no? I still, now my unit would be 1, but its price would be 120 and not 100. So that is what a unit is. We'll understand unit in better sense when we do mutual funds. Yeah. So the fund manager can invest in any of these kind of asset classes. It can be asset, debt, or cash equivalents like money market. So this is I was telling you. So in a simple pure insurance, the premium is taken only for insurance. However, in a ULIP, the premium consists of the charges for the insurance and also for investment. So this will be a bigger pie. A small portion of it would be invested. So if you see a pie here, a wedge here is kept aside for insurance. The rest of it is invested. And accordingly, the insured is allotted units. And from this, the fund manager will obviously take fund management and other charges, and it grows. So this money will always belong to the investor, whether he dies or he survives the maturity plan. So ULIP has an investment component as well, and which keeps on growing as per the market. Depending on the risk profile of the investor can choose any kind of fund. It can be an equity fund. Equity fund, as the name suggests, would do the major investment would be done in equity. Balanced. Any idea what balanced fund would do? Balance. What are the two components of investment?
Equity and debt.
No, those are the asset classes.
Okay, ma'am.
When we look at investment, what are the two first things we look at?
Risk
Ma'am,
and
capital. Ma'am,
Risk and
capital.
return, correct.
Okay. Yeah.
Okay.
Risk and return. So balance fund, as the name suggests, try to balance both risk and return. So what is the risk in equity? High, low, medium?
High.
High. Risk is high and return is also high.
Yes, ma'am.
And what about debentures or bonds? Or
debentures debentures have low risk and less return.
less, yeah. So we've seen bonds or fixed income instruments have less return and also less risk. So the balance funds try to manage the risk and return. So balance funds are basically a combination of equity and debt. They try to balance equity and debt to reduce the risk and increase the return. Now, what would be liquid fund? What do you understand by liquid?
The funds which are easily converted into cash.
Yeah,
Our
correct.
investment can easily
Yeah,
convert
correct,
into
correct.
cash.
Okay, so liquid we know is the ability of an asset to be converted to cash. Now, when we are talking about financial assets, what do you think is what kind of investment will you think is liquid, very liquid?
Government bonds.
Ma'am,
Bond,
treasury bills.
treasury bills, correct, but treasury bills are
Commercial.
what kind of instrument?
And ma'am, cash of deposit.
Yeah, that's okay. Treasury bill is correct, but what kind of investment is it? How will you classify as an investment class? It's a money market
Money
instrument.
market.
Money
Yes,
market.
ma'am.
Yeah. So liquid fund invest in money market and instrument of shorter duration. So that's why they are called as liquid funds, right? So the investor has a choice to choose what kind of investment class he wants to invest in. So you can the traditional plans. So ULIP is a considerably newer kind of product, but we have the traditional plan. So we know that LIC has always been there, but with the advent of the new insurance company, ULIP has gained prominence. Okay, so in LIC also you have certain policy which also have an investment component, but instead of investing in the market, these policies invest in traditional instruments. Traditional instruments means government securities and bonds. Okay, which will give you better return, ULIP or traditional instruments?
ULIP.
ULIP will give you better returns. Yeah. So, the investment returns of ULIP are better than traditional plans, because traditional plans invest in traditional instruments, whereas ULIP invest in market, so they are able to generate better return for the investors. So I'm sure your parents also would have LIC policies, and they will say, no, I'll get some money back or I'll get some bonus. So
Yes,
ma'am.
ma'am.
LICs or traditional plans are able to pay a bonus because they also invest, and that investment returns are shared with the investor. However, because they invest in traditional investment instruments, the returns are uh, lesser than the returns in ULIP. So in ULIPs, the premium paid is used for buying units, premium excluding allocation charges and invested as desired by the policyholder. In traditional plan, the amount of premium used for insurance coverage, other charges and purchase of unit is transparent and unbundled. All the premium collected by policyholder go into common hold and invested at the insurer's discretion. The premium amount used for insurance coverage, other charges and investment is bundled and not known to the policyholder. So traditional plans also invest, but they do not share these details with the policyholder. However, in ULIP, there is a, there has to be disclosure as per the norms by the regulator. So who's the regulator for insurance?
Ma'am, IRDI.
IRDI, yeah. So IRDA has issued instructions that the details of investment should be shared with the policyholder. Whereas in traditional plan, the insurance company does not share. It does the investment and does not share the details with the investors. So your unit linked plan is your charges and risk cover are all unbundled, because they will the insurance company will clearly tell you what is the charges, what the money which will be invested. Whereas in traditional plan, it would be a bundle that will be taken at one time without giving the details of the investment. In ULIP, the insurance company also provide for partial withdrawal. So partial withdrawal allowed, surrender allowed after 5 years. Loss, if any, depends on NAV. Now, NAV stands for net asset value. So So any idea what net asset value would mean? Net asset value.
After the deduction, some deduction,
After some deduction. And what is the asset value?
the value
Ma'am,
of the asset is known as asset value.
Value of the assets. So what are the assets they have invested in?
We invested in the equity, debt, or a money
Yes,
market.
correct. So the insurance company has invested in various kind of assets, and obviously they will also take a charge for it. So what they pay to the investor would not be actually the amount they have invested, or the actual value of the amount of the investment. It will be after deduction of some charges by them. So that is what NAV would basically means how much the investor is going to get for one unit. That is what is net asset value. So loans are allowed on ULIP. In traditional plan, also the partial withdrawal not allowed. Surrenders are allowed, but at a loss. And loans can also be provided on traditional plans. So, insurance policies can also be used for taking loan. So what kind of loan it will be? It will be a secured loan or unsecured loan?
Secured loan.
It is a secured loan. Because in case the customer does not pay, the insurance company, instead of paying to the customer, will pay it to the lender, will pay the money to the lender. So just like loan against securities, you can also take loan against your insurance policy.
Ma'am, what are the surrenders in traditional plans?
Surrender matlab, so as we've seen, insurance are long-term products. So it's not that you will pay the premium today and then it is over. No, you'll have to pay the premium regularly, or keep it invested over a long period of time. So it's 20 years, 10 years.
Yes,
so in
ma'am.
between, if you think you'll not be able to pay the premium, you can surrender it, or you need the money, you can surrender it. Surrender is to give back.
Yeah.
You will give back your insurance, saying that I don't need any insurance. Whatever money you have paid in the past, out of that, some amount will be paid to you. So that is the surrender value. That is the surrender value.
Okay, ma'am.
When you no longer want that insurance and want to withdraw the money.
And ma'am, we will not get the value what we have paid yet.
Yeah. Because they would have deducted the insurance charges, no? So that calculation is very complex. But you will get it. Every policy has some surrender value, which is calculated by the fund manager. Okay, so they have the surrender value. So when you surrender, there will be some money which will be given back. So this is one term which is very often used in term of LIC policy. They say bonus. Just give me a moment. Sorry, right? So yeah. So ULIP, there is no bonus except loyalty bonus in some case. Then it's very common in your LIC policy. They say that we will give you a bonus. Bonus is some additional money which is given. Actually, it is not a bonus. A company invests your money in case they make good profit. They pass it on to you. That is the bonus. So the policyholder is responsible for the benefit under the policy and not the insurer. Benefits are variable. And here the benefits are predetermined because they basically invest in traditional products, so they will know what is the return they're going to get. Whereas traditional plans, the bonus, here the return is basically market linked. So we've seen this traditional, ULIP investment is done in the market, and obviously the return would vary on the performance of the market. Investment return may vary depending on the market movements, and investment risk is borne entirely by the policyholder. Gain and loss in policy value depends on the market movement. Obviously, if the market goes up, there'll be a gain. If the market falls, there'll be a loss. Now, in traditional plan, the investor does not know where the investment is done. So there are two categories of benefits. Some are guaranteed and some are non-guaranteed. Again, they will depend on the performance of the policy. So for guaranteed benefits, the insurer bear the investment risk. However, non-guaranteed benefits such as bonuses depend on the performance of the insurer. And they will obviously not have any linkage to the market because the money is not invested in the market. It is invested in traditional instruments, usually fixed income instruments, where the insurer actually knows how much how much return they can expect. Now, you will understand these, the concept of unit better when we look at mutual funds. Now, have you ever, you must have heard about mutual fund. There are so much advertisements in today's time about
Yes,
mutual fund.
Yes.
What is that you understand by mutual funds? Mutual.
Ma'am, cooperative means relative, apsi.
Okay.
In mutual funds, there are different types. I know the one element that
Okay,
is
but what do you
SIP.
understand by yeah? What is mutual?
Mutual means
Mutual is
Agreement of all.
yeah.
Yeah.
It is a
For
mutual
all.
understanding between two parties,
Yes.
Yeah.
investor and
Right. No, it's not about the mutual understanding. Mutual means belonging to everyone. No, mutual means common.
Yes, common.
Right?
Known by
Mutual
everyone.
fund is a common fund. Now, if you want to invest, what you can do is you can look at, do your research and look at the options which are available for investment. However, everybody does not have the expertise or the time for doing it. Okay. So in that case, rather than doing the investment on their own, they do the investment through a mutual fund where money is collected from various type of investors and the investment decision is taken by the investment manager. And therefore, it is called a mutual fund because here the fund manager is doing the investment for everyone. And the returns also will be shared equally. So mutual fund is a vehicle to mobilize money from investors to invest in different market and securities in line with the investment objective agreed upon between the mutual fund and the investor. So here also, the fund manager will tell you where is that you want to invest. You want to invest in equity or a fixed income instrument or even precious metal. And in India, now we have mutual funds which also invest in real estate. So depending on your personal risk profile, you can select what kind of fund you want to invest in. The investment would be done by the investment manager. So to define, mutual fund is a collective investment scheme where many people pool in their money together for investment done by the investment manager. Not the investment manager, yeah. So mutual fund is a vehicle to mobilize money from investors to invest in different market and securities in line with the investment objective agreed upon between the mutual fund and the investors. So we have seen that different kind of securities have different kind of risk, and therefore various kind of investors would want to take various kind of risk. So depending on their risk profile, the investor can decide where is that he wants to invest that money. Right? Uh, Through investment in a fund, a small investor can avail a professional fund management service offered by the asset management company. So if you have understood ULIP, the concept is the same. In ULIP also, the fund manager does the investment. What would be different then between mutual fund and ULIP? What will be different?
Ma'am, security purpose.
In ULIP, insurance is also included. While in
Correct.
mutual fund, there's no insurance.
Correct. So in a ULIP, you will also get insurance, but in mutual fund, you will only get the return generated by your investment. So there's a similarity is that in both cases, the fund would be managed by the investment manager, whereas in ULIP, you will also get the insurance benefit. In mutual fund, you will not have. So that is the basic concept of mutual fund. So
Ma'am,
purpose,
am I audible?
yes, you are. Yes, Akshay.
Okay, okay, ma'am. No, ma'am, I told that these are the less secure bonds and investment.
I'm sorry.
Mutual funds, ma'am.
Mutual
And
funds are?
mutual funds investment are basically less secure, ma'am.
No. In terms of investment, both are same. Because in ULIP also the investment is done in various kind of securities. So they are as safe or as insecure as the market. So in ULIP also
Because
you
ma'am,
are
we get an
investing the money in investment. So in mutual fund also you can have a debt fund. It's not that you can only have equity. Mutual fund also you can have a debt fund.
okay, ma'am.
So from
Because we can
security
get
point
an
of view,
insurance
the
in ULIP.
difference is that in ULIP you have an insurance, in mutual fund you don't have that.
Yeah.
So that is the only difference.
Okay.
Yeah. So purpose to provide an opportunity to invest. No insurance coverage as we have seen. Mutual funds do not give any insurance coverage. It is only investment. Here the perspective of fund manager is short term, because people might want to invest for shorter term as well. Insurance usually is a long time product, but in mutual fund, the fund manager will have a short term perspective. Similar to ULIP, it is regular and disciplined payment. Choice of investor to benefit from rupee cost averaging. Rupee cost averaging is that when the market is high, you will have to pay a higher price for the investment you're buying. But same time, if the market is low, you will have to pay a low price. Every time to look out for that is not possible. So if you are doing a systematic investment, that means you're investing at regular intervals, you can get the benefit of rupee cost averaging, which would mean that you can buy the share, buy the security at both time when the security is highly priced and also when the security is trading at a lower price. So mutual fund assists investors in earning an income or building their wealth. How will it help them build their wealth? How can the investor build his wealth?
By investors.
Yeah.
Investors build their wealth in investing in the security.
So what will happen if we invest in the securities?
They will earn a high return.
Yeah. So they will get a return.
Yes. Okay.
Return in the sense, if the investor has got equity, what kind of returns can he expect?
High return.
But what are the different type of returns he can expect?
Means, ma'am, in terms of what? Ma'am, in terms of what, I didn't understand the question.
When you bought a share,
Yeah, okay, ma'am.
what are your expectation of return?
If I'm buying the shares, I'm expecting that in some time the value of the share will increase, so I'll get the
Correct.
profit.
Yeah. So anybody who's buying a share expects that the value of the share would increase, right? Also, you are an equal partner in the company. So if the company makes profit and it distributes the profit with the investor, what is it called?
Profit,
Hmm?
dividend. Dividend distribute between the partners.
Correct. Correct. So when you bought a share, you are
Oh.
expecting two kind of profits. One is capital appreciation, that is the change in the value of
Share, and
share.
second is the
Increase in
dividend.
yeah, second is the dividend.
Okay.
Right. So even if you buy those shares through the mutual fund, that means you don't buy directly, you buy it through the fund manager, you are expecting that the money would increase. The biggest benefit is that even with small money from investors, the mutual fund can have a large corpus of money. So for example, I just have 500 rupees. Now, if I go to invest on my own, it will be very difficult. But if I want to invest through mutual fund, I can do this because there'll be many people with these 500 rupees, many people who just have 500 rupees to invest. So mutual fund gets them all together. And if it, say for example, collects this 500 rupees from only just 10 people, it would be already 5,000 rupees. So that can be invested. So we are talking about in thousands and crores, you know. So mutual funds tap a large corpus of money from diverse investors. So they raise money to invest in various projects or pay for various expenses. Also, if the mutual fund has invested in a new company, they can also check on the operation of the investee company. So if you remember when we were looking at private equity.
Yes, ma'am. Yes, ma'am.
Yeah, so we had seen that mutual funds and insurance companies are investors in private equity because they have access to a large corpus of money, and also they have
Large, high return.
yeah, and they also have time, right? So in case the mutual fund is a major shareholder in a company, in that case they can also have a say in the working of the company. Mutual fund also boosts the revenue collection of government through tax and other means. In the recent past, you would have seen that there are a lot of advertisements for investing in mutual funds, and especially with cricketers because they are probably the most popular icons in the country. So you'll see cricketer promoting mutual funds, right? Because government wants people to invest in mutual funds. That will one get them to drive the economy because the money would be channelized. Also, the mutual fund will pay taxes to the government. So it is when people invest through mutual fund, it is beneficial for them, but it is also beneficial for the government and the economy, which promotes further economic development and nation building. This is a very, very important point as a market stabilizer in countering large inflow or outflow from foreign investors. So in the recent past, we've seen that the stock market in India is achieving new highs, and it is not that volatile anymore. Now, earlier, if I say maybe 5 or 10 years back, if you look at the movement of the share market, you'll find it very volatile. Volatile means the changes are very sharp. So it will fall down and rise very sharply. That used to happen because of foreign investors. When the foreign investors feel that India is a good market, they will come and invest. What will happen to the stock market? How will the price move? High or low?
Price low.
Uh,
When the foreign investor, so price
Yes.
market will high.
Price will, so when simple economics, when there is a huge demand,
The price will be
price
high.
increases. So people
Yeah.
start buying. So a lot of foreign investors come and invest in India because India is a developing economy. So they can get better returns in India rather than developed economy. So rather than investing in US, they come and invest in India. But then something happens. You know, one political party loses the election, or one political party, wins the election.
Yes.
Now this creates instability in them, and they will take out that money. So obviously, when the money goes out, the stock market falls. However, for the last 10 or 15 years, the government has enabling retail investors, people like you and me, to invest in the stock market, and especially through mutual fund. So when large number of people invest, it provides stability. So people like you and me, if we have invested, we will not take our money and run away. We will stay in the market for a long time, and which provides us stability. So this is a very important aspects of mutual fund, because earlier the market was very volatile because foreign institutional investors would come and invest. And the moment they saw that there was some instability, they would quickly go out. And when they take out the money, obviously the market would fall. So if you've been reading the newspaper, you will see that sometimes the market rises very sharply. So you see foreign institutional investors have come and invested, and sometimes the market would fall very sharply because the foreign institutional investors have gone out. So that used to create a lot of volatility in the market. Now with retail investors being invested in the market, it has provided stability, because retail investors do not buy and sell very soon. They take their times, and usually all of us invest for an objective. So for example, a parent would invest for his children's education, right? So he would keep it invested for a longer time. He would not take the money out. So that provides the stability to the market. So mutual fund acts as market stabilizer in countering large inflow or outflow from foreign investors. And it is a key participant in the capital market of the economy. So mutual fund also plays a role in the economy of the country, just like a bank. No. So what does a bank do? A bank borrows money and then lends it out. And when people take a loan from the bank, they use it productively. Similarly, mutual fund channelizes the money from people who are in surplus and then invest in equity, right? They invest in equity of a company. That means that company now can start productions, or start a new business. When a company is starting a new business, obviously it will generate employment. So it has a it has
Economy development.
channel effect on the economy. So it is a key participant in the capital market of any economy, and it also gives impetus to the economy by providing the capital.
Ma'am,
Yeah.
ma'am, can you explain what is rupee cost averaging once more?
Rupee cost averaging. So you understand average. Average you understand, no?
Yes, ma'am.
What is average?
Average is sum of two numbers, and you'll be dividing.
Yeah.
the
So sum
average.
of incidents
Yeah.
divided by number of incidents. That
Yes,
we
ma'am.
all know, average.
Mm.
So for example, I want to buy Infosys shares, right? Now
Yes,
I bought it when it was at 1700, all time high, 1750 rupees, all time high. I bought it. I bought 100 shares at one go. Okay. So my average cost would be 1750 rupees, for example, right?
Yes, ma'am.
However, rather than buying all the 100 shares at one go, I bought it over a period of 1 year, for example, right? So I started buying from January, and I started buying, for example, 8 share every month. So in the month of January, the cost was 1600. Okay. In February, it was 1650. Sometime it was 1800 also. But if I total everything and divide it by the number of shares I owe, my cost comes to say 1675 rupees, right? So that means I could buy the security at a lower price than if I had bought it at one go. That is rupee cost averaging,
Okay, okay, okay.
right? So I can buy my, if I'm a systematic investor, I can take the advantage of the market falling also, rather than buying the shares at a very high price when the market is all-time high. So fall and rise of market should not decide your condition to buy. If you are doing systematically investing, you will buy some certain securities when the market is down and certain securities when the market is high. But if you calculate an average, your average cost would be lesser, and that is what is rupee cost averaging. Okay, so mutual funds seek to mobilize money from all possible investors, and depending on the investment preference, the investment is done. So different investment preference plus different pool of money. Each such pool of money is called a mutual fund scheme. So you were saying some, Akshay, mutual funds are safer. ULIP is safer than mutual fund because mutual fund invest in equity. No, that's not the case. Mutual fund can invest in like ULIP. If they can invest purely in equity, they can invest in purely in fixed income instruments. They can also invest in a balanced thing. So invest in both, right? However, each scheme has a pre-announced investment objective, right? So investment objective can be growth, investment objective can be regular income, investment objective can be capital protection. So depending on the investment objective, the investment would be done. So for example, if the investment objective is growth, where will the mutual fund invest?
Ma'am, please repeat the question.
Equity. Yeah, growth we know can be obtained only from equity. Regular income. Regular income, where will you invest?
For
Fixed income instrument. You choose fixed income instrument because you know how much money you will invest, right? If there is a person who wants growth and regular income both, then you will make a balanced fund. You will invest in both depending on the objective of the
Profit.
mutual fund, of the scheme. The fund manager does the investment. So when investors invest in mutual fund scheme, they are effectively buying into its investment objectives. So various mutual funds have different schemes depending on the investment objectives. So mutual fund schemes announce their investment objective and seek investment from the public. The investment that an investor makes in a scheme is translated into certain number of units in the scheme. So unit is something which we saw in ULIP as well. So for example, SEBI says one minute, just give me a minute. Right. So for example, now not SEBI, as per SEBI's rule, each unit has to be 10 rupees. Right. So when the investor invests 1,000 rupees, how many units he will get?
100.
100 units. So we'll get 100 units. Now this 1,000 rupees, and what is the value of these 100 rupees?
Ma'am, 100 is
100. Yeah.
units, ma'am. 100 units.
Yeah, 100 units. Each unit is 10 rupees.
1,000 rupees.
Each unit is 10 rupees. The investors has invested 1,000 rupees. Unitary method, no?
Yes, ma'am. 100 units equals to 1,000 rupees.
Yeah. One unit is 10 rupees.
10.
Yeah.
100 units is 1,000.
Yeah. Understood, Akshay?
Yes, ma'am.
Yeah.
No, ma'am. No confusion.
Okay. So now the fund manager will invest this 100 rupees into the market. depending on the market. This 100 rupees might become 200 rupees, 1,200, right? Possibility, no? When the share market is rising, this can become 1,200, right? But the number of units will
Yes,
remain
madam.
the same. So here the investor obviously
Same.
has been benefited with 200 rupees because each unit has risen. Now the other concept we saw was NAV. Okay. Now the corpus has become 1,200 rupees, but the manager will also take his fees. So manager fees and other expenses. Then divided by number of units will be your NAV, right? So again, so for example, the 1,200 rupees and the manager fees and 100 other expenses are 100. That means your total money is 1,100. 1,100. How many units we started with?
100.
100.
So what will be the NAV now?
11 rupees.
7.
And this is what the investor will get in case he wants to sell his unit. So we saw the concept of NAV, which is net asset value, which is the amount the investor is going to get in case he wants to sell his units, or the money he has to pay to buy the units. Okay. To start with, each unit is issued for 10 rupees, but depending on the rise or fall in the market value, the value of the NAV would keep on fluctuating. Yeah. So that is what is a unit. So mutual fund scheme, announce their investment objective and seek investment from the public. The investment that an investor makes in a scheme is translated into certain number of units in the scheme. An investor in a scheme is issued a unit of the scheme. So anybody can see a benefit in mutual fund. What is the benefit the investor will get? He has to, disadvantage obviously is that he has to pay the manager fees. But can you see any advantage of investing through mutual funds?
Generally, they have high returns.
High returns. Why do you think there will be high returns?
Because they invest in equity.
So I can do the investment on my own.
But still, it was done by a manager. But the equity return will high. That's why it is profitable.
It's not only that the equity return is high. So I can also invest in equity, but I will not know which shares to invest. Here we have a professional, a person who has the requisite knowledge and experience for doing the investment. So here, rather than investing on my own, the investment is done by an investment manager who is qualified to do it. So my probability of earning returns is higher. So for example, in lockdown, I'm sure all of a few of you would have cut your own hair, right? But if you had gone to a salon, what is the benefit of going to a salon? Or,
Get a
going
perfect.
to,
Or
yeah,
hairdressing.
correct. You get a perfect cut and you don't mind paying also, right? Right. So that is one benefit of the mutual fund, that you get professional advice and therefore your returns can be better.
And because it is mutual for it.
Yeah, it is mutual. And it is mutual. So now that doesn't mean you will make profit. No, mutual, it can be mutual profit, it can be mutual loss as well. So that's not the case.
Yeah.
But here you are trusting an investment manager who is probably more qualified than you and better experienced than you to invest in the stock market, right? So that is one benefit. Any other benefit? What is the advantage of investing through mutual funds? So they can provide you better returns. What else can be the benefit?
Ma'am, one thing I can guess that we can give some suggestions to manager.
You cannot do that. You can definitely cannot do any suggestion.
Okay, ma'am.
Suggestions cannot be given. The fund manager will invest on his own. There's
Ma'am,
lacks of,
we have diversification.
yes, you can get diversification because the amount of money which will be collected by the fund would be high. So the example I was giving you, 500 on my own and 5,000 with 10 people. So there are thousands of people who will, thousand or lakhs of people who will invest in one scheme. So mutual fund manager will have a huge chunk of money at his disposal, which will help him diversify. Diversify means to pick up different kind of securities to reduce risk. Also, one benefit of mutual fund is, I can start investing with a very small amount.
Yes, sir.
Yeah. So even if I'm a small investor, I can
500
invest
from
in mutual
500
funds
rupees.
through mutual funds. So these are some advantage of mutual funds. Also, I can this mutual fund is liquid. I can buy and sell it anytime. So redemptions allowed at any time, which is highly liquid. Investor many may benefit from short-term investment. Entry to and exit from the fund is based on the fluctuation in the financial market. Return depends on entry and exit point. Obviously, this is like simple profit. We know that profit is your cost price minus your selling price. So what time you enter the market, that means you buy, and what time you sell will decide your profit. So fund manager allows creates liquidity by not investing all the money at one time. So it maintains liquidity for allowing redemption. So a large a portion of the portfolio is maintained in cash by the fund manager to maintain liquidity and allow for redemptions. Now you have two types of mutual fund. One is open-ended mutual fund and closed-ended mutual fund. Open-ended mutual funds, you can think of as a room which has a door, but the door is open. You can enter and exit at any time. On the other hand, there are another kind of mutual fund which are known as closed-ended mutual funds. So closed-ended mutual funds are mutual funds where you cannot enter and exit at any time. So if you have a room which the door is locked, so you cannot enter when the door is locked. You can only enter when the door is open, right? So these are two kinds of mutual funds. Open-ended mutual funds allow you to enter and exit at any time, whereas closed-ended mutual funds have a specified time for investment and exit. So entry in open-ended mutual fund, investors can enter and exit. Okay, all of you who think they are bogged down by too much of information, you are not understanding. That's okay. We in the next semester we are going to study mutual fund for at least 5 days. We'll study this in much more detail. This is just the overview of mutual fund. So if you're getting overwhelmed, just be with us. In the next semester, we are going to study mutual fund in very, very detailed manner.
Still, ma'am, it is not being over.
I'm sorry.
Still, it is in control, ma'am. Still, it not being over.
Okay.
Yeah.
So open-ended mutual funds are where exit and entry is allowed. Exit, entry, I hope all of you understand. I can buy and sell
Yes, sir.
anytime. So investors enters or exit at any time, even after NFO. NFO stands for new fund offer, which is like your IPO. You know, what is an IPO? When the company is issuing the share for the first time.
Yes.
So when a mutual fund scheme is issuing, coming out units for the first time. That is the NFO.
Ma'am, IPO.
Just like IPO, yeah.
Yeah.
Open-ended mutual fund is a going concern. That means anybody can enter and exit at any time.
Ma'am, can you just repeat the NFO?
NFO is like the IPO. IPO, when the company is issuing the share for the first time, you call it an IPO. When a mutual fund scheme is issuing the units for the first time, you call it an NFO. It
Yes,
stands for new fund offer. Clear, infant?
Yes, ma'am, clear.
So the scheme continues operation with the remaining investor. And no time frame is in which it is closed to be. So it's like just like your gallery where people can walk in anytime and they can go anytime. So the ongoing exit, entry and exit investor implies that unit capital in open-ended fund would keep changing on a regular basis because people are investing and getting out. Then you have closed-ended mutual fund. As the name suggests, you cannot invest at any time. You have to invest only at the time of NFO. So closed-ended mutual fund are that they have a fixed maturity. You cannot exit before that. After the NFO, investors will have to transact only through the exchange. So in a open-ended mutual fund, you can go back to the fund manager and get your money back, but not in case of a closed-ended fund. In a closed-ended fund, you'll have to sell it in the stock exchange. So after the NFO, investors will have to transact only through the exchange. Post NFO, sale and purchase of units happen or from counterparty in the stock exchange and not to or from the mutual fund. The unit capital in scheme therefore remains stable. So as I told you, a close-ended thing. So if you are sitting, 5 people sitting in a room and you have closed the door, only 5 people will stay. Because now nobody can go out and nobody can come in. Right? So you will only have 5 people sitting in the room. But just again, if there is a room where the door is open, at different point in time, you'll have different people in the room. So somebody will walk in and somebody will walk out. So therefore, the number of people will change. So that is what we read in the earlier part of the slide, where it's said that the unit capital is the total amount of money in the mutual fund will keep on changing because people can put in money, they can also take out money. That is not the case in closed-ended. Closed-ended, whatever money has been put, it will remain the same until maturity. Are you getting the concept?
Yes, ma'am.
Akshay?
Yes, ma'am.
Okay. Then you have a combination of closed-ended and open-ended, which is known as the interval fund. So interval fund has windows for for maturity. So it's like if you have ever gone to see a play, they once the play starts, act 1 starts, they will not allow anyone in. They will not allow anyone in and they will not allow anyone to go out. Exit. However, after that, they will open the door for some time and allow people until they are ready for act 2. So those are interval funds. So interval funds have these kind of windows in between to allow enter and exit. They have they remain open-ended fund for some certain time and they remain closed-ended fund for certain time.
Ma'am, interval means that we can invest in the mid.
Yeah, interval. Whenever the window is open, you can invest. When the
Okay.
window is closed, you can't.
Okay. Now window means that any time
Window
period.
means time period.
Okay, okay, ma'am.
time period. So you can, relate it to your school.
Yes, ma'am.
School, your teacher will tell you, no, 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 no going
You
out
can't.
until the interval.
Yeah.
Yeah, so she will not allow you to go until the interval. So once the interval is there, then you can go back and come back during that interval. Again, after the interval, when the class starts, she will not allow you again to move. That is the interval fund. So it has a window in between for people to enter and exit. So unlike in a purely closed-ended scheme, they are not completely dependent on the stock exchange to be able to buy or sell shares. There is an interval period which is minimum duration of an which is where people can enter and exit. So minimum duration of an interval period as an interval scheme plan is 15 days. And the mutual fund provides an exit route for investors to exit or enter. So unit have to be compulsory listed on stock exchange to allow investors an exit route. So you can, it's not that, interval funds and closed-ended funds don't have liquidity. They cannot be returned to you cannot buy and sell to the fund manager. You can obviously buy and sell to the stock exchange. The way we had seen about equity shares, right? Equity shares, you get it in the IPO, but you can't give it back to the company. You can't go back to the company saying that take these shares and give me my money back. You can't do that. If you want liquidity, you'll have to buy and sell at the stock exchange. So that is what happens in the close-ended funds, where the mutual fund, the fund manager does not allow you to take out the corpus from the fund, but you obviously have the liquidity by buying and selling it at the stock exchange. Another classification of the mutual fund can be active and what is the opposite of active?
Passive.
Lazy.
Passive.
Passive. You said hazy or crazy?
Lazy.
Oh.
Lazy, ma'am.
Lazy, active, yeah, active and lazy, yeah, correct. Or active, passive, we have all studied in school, active voice, passive voice,
Yes,
Yes,
ma'am.
right? So active, where there is a lot of activity or a lot of action. Passive is where there is no action. So in mutual funds, you can have active funds, where the fund managers keeps on looking at the market, and based on that, he decides what the investment is to be done, right? And so he keeps on monitoring the market very easily, very closely, and then buys and sells the securities as per the market. Now then you'll have a passive manager who will just sit quiet. So who's better, active or passive?
Active.
Active.
No, it is all dependent. It's
Why,
not
ma'am?
active is good and passive is bad. Passive is also has its benefit, because passive, the risk reduces because you have decided an investment strategy and your investment would only be through your strategy. You will not waver.
Ma'am,
So in active, the returns may be better, but passive, the risk is less. Yes.
Ma'am, I think in passive, I don't know if I'm correct. I think in passive, maybe the intervention of the fund manager will be limited.
Yes, correct. Correct. The intervention is limited not because he's lazy, but you have launched that fund with a certain strategy.
Yeah, yeah.
So this is the strategy we are going to follow. We are not going to be dependent on the movement of the market. Whatever is the movement of the market, we will go as per the strategy. So it's reducing the risk. The passive fund manager will have a lesser risk, whereas active fund manager would have higher risk. So again, a passive fund manager might not be able to generate that high returns, but active fund manager would generate better returns. So it's again a game of risk and return. Yeah. So actively managed funds are funds where fund manager has the flexibility to choose the investment portfolio. The investment manager can act upon the broad perspective of investment objective of the scheme. Since this increases the role of the fund manager, the expenses for running the fund turn out to be higher. Because he's buying and selling, obviously, there'll be more charges. Investors expect actively managed funds to perform better than the market. Then you have the passive fund. Passive funds invest on the basis of a specified index where performance or it seeks to track. So thus of passive fund tracking, the BSE Sensex would buy only the shares that are part of the composition of the BSE Sensex. The proportion of each share in the scheme portfolio would also be the same as weightage assigned to the share in the computation of the BSE Sensex. Thus, the performance of these funds tends to mirror the concerned index. Since the portfolio is determined by index itself, the fund manager has no role in deciding the investment. Therefore, these schemes have low running costs. So they have low running costs and low risk compared to the market, whereas active funds will have higher risk and higher cost for the management. Now this is easy. Other classification for the mutual fund can be debt, equity, and hybrid. So tell me what will a debt mutual fund mean? Why will you call a fund a debt mutual fund?
Debt mutual funds, when we invest, we occur as a debenture, like when
Okay.
when we become a creditor of a company, it's we are debt.
So what will these funds do? They will borrow or they will lend?
Ma'am, borrow.
They will borrow. We give a loan, like so we are a credit. Yeah, we are
We
a
will be borrower.
creditor. So we are the lenders.
We means who?
Means investors.
Investors are
Investor.
not lenders. Investors
Yeah,
are not
investor will
lenders.
borrow.
Investors are investing.
Oh, okay.
Okay, so mutual fund is not a creditor, is not a debtor for the investor. He's just an agent for the investor. He's doing the investment on behalf of the investor. So in mutual fund, it's not like bank where the mutual fund borrows from the investors for further lending. No. So mutual fund is not a debtor and neither the investor is a creditor. Anything else? What would debt mutual fund mean? So that means the concept of mutual fund itself is not clear. Otherwise, it is very easy. So first, tell me what does what is a mutual fund? What does it do?
Ma'am, pooling of funds
Yeah,
and investing those in the variety of investment
correct,
options available.
correct, correct. So then, what will you understand by debt mutual fund?
We are investing in the debt products.
Correct. These kind of schemes will invest in the debt
Products.
scheme.
Okay.
So debt mutual funds invest in debt securities or fixed income securities.
Okay.
Now, where will equity fund invest?
In
equity.
Equity products.
And hybrid means a combination. So hybrid fund will invest in both. So though we say they invest in equity, but they have to invest around 65% or more. So most of the investment would be in equity. Yeah, so equity, a scheme might have an investment objective to invest largely in equity shares and equity related investments like convertible debentures. The investment objective of such funds is to seek capital appreciation through investment in this growth asset. Such schemes are called equity schemes. Then you have debt schemes. Debt obviously will invest in debt securities or fixed income securities. So schemes with an investment objective that limits them to investments in debt securities like treasury bill, government securities, bonds, and debentures are called debt funds. Then you have hybrid. Hybrid, as the name suggests, combination of more than one. So hybrid funds have an investment charter that provides for investment in both debt and equity. Of late, there have been funds that also invest in gold along with either debt or equity. So hybrid fund will invest in more than one kind of asset class. So I hope by now at least asset classes clear. You have understood what are asset classes, what are the different kind of asset classes in financial securities, right?
Yes, ma'am.
Yes, ma'am.
Okay, now let us look at financial planning. Now, so some of it we had seen. We will again. I don't think we will see it in very huge detail now. We will see it in very in detail only when we reach semester 3. But we'll just have a general you know
Overview.
general idea about this. Okay. Now we have seen some of it. What does planning mean?
Deciding in advance
Deciding in advance. Oh, so what will financial planning mean?
means decide in a finance related
Deciding where the money should go.
Very good.
Okay.
You will decide where the money should go,
from
right?
and,
Correct.
and where it is come
But
from.
you are doing it for the client. Now, how will you know, or how will you decide where the money should go for the client? What are the things you need to know?
About
Decide
the how much investor can bear the risk.
Okay, so you need to know the risk of the investor,
Yes, ma'am.
right? You need to know the financial objective of the investor. Only then you will be able to invest. So
Yes.
financial planning is a laid down process for deciding where the money should be put for the investor to help him achieve his financial objectives. So financial planning is not a one-day process. It's a well detailed process where you understand the investor's requirement and risk profile before you suggest him any investment. And this is one thing which is growing in retail banking. So retail banking is not only about accepting deposits, it's also about investment planning. And especially if you look at with everything being automated, banks are looking at people who can also advise the investors for various kind of investment. In the recent past, you would have seen the interest rates are falling. So the FD rates are falling, right? So where should the people invest? So there will be an increase in spending. We have seen this. This is a part of monetary policy. When RBI wants growth, what it does is it goes and reduces the interest rate. So people don't find it attractive to save their money. So they spend. So people want to save less and spend more in the falling interest rate scenario. These are the various financial products. So we've seen this already. These are the products offered in retail banking, but in today's time, banks also offer investment advice as a part of retail banking. So retail banking, as we have seen, is more about deposit and investment products. There might be some loans also which are required by the retail customers, but basically they are looking for saving rather than spending that money. So these are also some products which are offered as a part of retail banking, which is mortgage, equity, or mutual fund, personal loan, time deposit, ATM card. Now, financial planning is the process to determine what should the investor use, which of the products the investor should use. Right. So, for example, the investor wants to buy a house. The customer wants to buy a house. but he does not have money. What will you do? He does not have money. Which product will you tell him?
Loan.
A loan. Yeah. He wants to send his daughter for studies abroad. Which product you will tell?
Study loan. Educational loan.
Apart from loan, can you tell him something
He
else?
can, if the customer doesn't have a money,
No,
if the money they have, they can invest, take a FDs
correct.
or equity.
Or he can
They
start
take
by
investment.
creating a corpus. He can
Yes.
start investing for meeting that expense. That also can be done, no?
Ma'am did not get this point.
Okay. So there is a investor who
Okay.
has a 5-year-old daughter. He wants her to
Okay.
send abroad for studies. What will you tell him?
Okay, ma'am.
Very good, sir. Anything else
Yeah,
can
we
you
will
tell him?
appreciate him.
You can appreciate, yeah, but that is not going to help him in any way. How can you help him plan this education? By telling him various investment
In terms of
products.
financial,
Tell him investment
yeah.
products. No, if you tell him, sir, invest. So, for example, invest 5,000 in a recurring deposit, which will become, 1,20,000 in 2 years or more, little more than that. Also, if he can invest in the capital market to generate more money. Right. So, financial planning is about knowing the right kind of product for the investor.
Yes, ma'am.
So that is what is financial planning. And yesterday we were looking at suitability of the product. Suitability you will know only when you understand the customer. And this is now in today's time the requirement of retail banking. So relationship management and wealth management, you have to know the customer before telling him the product. And there are a lot of innovation in banking, in product development and differentiation, innovation and banking processes, marketing, prudent pricing, micro planning, customization, technological upgradation, home, electronic, mobile banking, cost reduction and cost selling. In all these, customer interest is the paramount importance. So yesterday also when we were looking at retail banking product, we've seen that banks in today's time have become customer centric. That means they keep the customer in the middle of their endeavors. So the customer's interest has to be taken. The suitability of the product, the product requirement, all that you have to keep the customer in mind. And a lot of innovations are happening to make banking more convenient for the investor. Oh. Okay, so this we have seen in introduction of the banking. So we have seen Keynesian theory about economics. So he talks about the amount which is left over with people after their expenditure is their saving. So according to Keynesian economics, the amount left over when the cost of person's consumer expenditure is subtracted from the amount of disposable income that he or she earns in a given period of time. So saving is the money left with you after you have met all the expenditure. Saving can also be seen as the amount of money that is left after all personal expenses have been met. So we've seen this, we've seen when we're looking at economics and introduction to banking, we've seen this is what saving means. But saving itself is not enough. The saving needs to be invested. The saving needs to be used properly to generate the right kind of returns. So people do saving for various purpose. The saving can be done for a child's marriage, for a child's education, even for vacation, for retirement, or buying a house. And there where the financial planner steps in. So financial planning is a process to help the customer meet his financial objectives. So we all know child marriage is expensive. It will need a lot of money. Education is expensive. Vacation also, if you want to go to an exotic location, it's going to be expensive. Retirement, you definitely need to plan, and buying a house also. So here the financial advisor can step in and plan accordingly, depending on the saving of the investor, to help him achieve this financial objectives. So I think let's take a break. We have a long way to go, but still let's take a break. It's 15:35, that means 3:35. Let's meet at 3:50 and continue, right? Hello. Yeah, let's meet at 3:50 and then we'll continue.
Yes, ma'am.
Okay, so are we back?
Yes, ma'am.
Yes, ma'am.
Let's start. Okay. So this is what a financial planner helps the customer to achieve. But for that, he'll have to first know his investment objectives. Okay. Along with the investment objective, what else would be you should know about the investor to make a financial plan for him? So what are the things you should know about the investor to make a financial plan for him?
His capital, what amount, how much he invests.
Yeah. How much he can invest, how much he will need, what is the time period, what is his risk profile.
Purpose.
I'm sorry,
Purpose.
the purpose, yes, objective, yeah. So for example, you know, the objective is buying a house. Now investor might not have you know that kind of money. Investor might not have that kind of money to pay, right? So you know that and even if, like, and the maximum he can save is say 50,000, but 50,000, even if he saves over a period of 2 years, he'll not be able to buy a house. Then you will have to suggest a different product. Probably he can have some corpus and then also take a housing loan. Yeah. So knowing the purpose is also very important for financial planning. And we know inflation is a very big enemy of hard-earned saving. So can somebody throw some light on this? Whatever we have seen earlier, can somebody throw some light on this statement?
Ma'am, which statement?
Inflation is the biggest. You can't see the screen, can you?
Yes, ma'am. I
Yes,
can
ma'am.
see.
So
Ma'am,
who's the biggest enemy of your hard-earned savings? We see inflation here.
Yes,
Can
ma'am.
somebody explain how inflation is the biggest enemy of your
Yes,
hard-earned
ma'am.
saving?
Yes, ma'am. Whatever we earn the saving, inflation rate decrease it means it decrease our real purchasing power.
Correct.
Real return will decrease.
ma'am, and say if you're investing in a savings deposit account and in a 10 years period of time, if you're planning to earn this so many amount of money, but due to inflation, you will not be earning the planned amount of money. You will be earning little less than that, lesser than
Yeah.
that.
Yeah. So actual value of money would be lesser than the amount you have earned 10 years back, right? So we have seen time value of money. We have seen time value of money in quite detail when we were looking at capital budgeting. So money received today cannot be compared with money received tomorrow, because tomorrow the value of the things you want to buy also would have increased. So I'm sure there must be discussion in your families when your parents say, oh, that was, that time I should have bought a house. That time I was getting a good price. Now it's become very expensive. So we all talk about it. So inflation is basically the rise in price of a commodity or a thing. And because of that, your return decreases and your value of money decreases. So we have seen inflation robs your purchasing power. So today, something which I can buy in 10 rupees, I will not be able to buy in 10 rupees tomorrow. The biggest example is Maggie. All of us love Maggie and all of us buy Maggie. So you'll say, no, the Maggie price is not increased. But if you look at, the quantity has decreased. Initially,
Yes, ma'am.
yeah, one packet of Maggie was enough for one person. But if you
No.
cook one packet of Maggie now, you feel the quantity is less, right?
Yes, ma'am.
Yeah. So Inflation decreases the amount of money you can, amount of goods you can buy. So you are still paying 12 rupees or 10 rupees for a packet of Maggi, but the quantity of that has decreased.
Ma'am, 5 rupees.
5 rupees. Yeah, 5 rupees also. The 5 rupees, the quantity would be very less, no? Yeah. So you can see this is a example from the US. So 95.55, you could buy 6.5 burger in $1. Now, in 2004, you could buy only one burger in $1. And probably by the time in 2003, in 2073, you might not be even able to buy half of it. So we all know, I'm sure, you guys might not be old enough, but if you remember something of your childhood, you will know that things which you could buy in 10 rupees or 5 rupees at that time are not available for the same price today. So that is what inflation is.
Yes, ma'am. Chips packets.
Ma'am, for
Packet.
chocolates and all, we
Yeah.
Yes.
get it for paisa.
Quantity was 5 star. Quantity will become so little.
Yeah, it
Correct.
will be like 50 paise and all. Like
Yeah.
I still remember that.
But today's time you can't even I don't think when was the last time I saw 50 paisa.
Yeah, even everyone. Yes.
You can't buy anything in 50 paisa today.
Yeah, I think it maximum to the max till 2005. Beyond that, I didn't remember.
In 1
using
rupees,
it.
we got 4 toffees
Yeah.
in my childhood.
Yeah. So if you if you want to understand inflation, go and talk to your grandparents. They'll give you a very good perspective. They'll say in 500 rupees, no, 1000 rupees, I bought 10 grams of gold.
Yes,
They're the
ma'am.
biggest, they are the probably they would have seen inflation from a very different perspective and for a very, very long time. So they'll give you very good examples.
Yes, ma'am.
Now, if you look at this chart today, so whatever you can buy in 10,000 today, assuming that the inflation rate is 6% per annum, you will need 17,908 to buy it. So can you calculate this? Can you calculate? Did we see? Hello?
Yes,
Yes,
ma'am.
ma'am.
For future value.
I'm sorry? Future value. Yeah. So from present value, we are calculating the future value.
Ma'am,
Taking 6%.
future value.
Yeah.
Yes,
Hello?
ma'am.
अक्षय आपकी आवाज एकदम एको कर रही है.
Hello, ma'am. Ma'am, actually, I'm
Ma'am,
hello.
Yeah.
ma'am, around 16,000.
Yeah. So I'm sure all of you can calculate. We have seen how to calculate future value. So simply we know
Yes,
that
ma'am.
this from a formula from our childhood, no?
Yes, ma'am.
A is equal to P
Compounding.
1 plus I to the power n.
Yes, ma'am.
Right? So by that simple calculation, you will need 17,908 rupees to buy a thing which you can buy in 10,000 today. So again, it will keep on growing exponentially. And after 40 years, you will need 1,02,857. And this is what financial planning is. So for example, I am 25 years now and I want to plan for my retirement. And so for example, my personal expenses are 50,000. Okay. So assuming that this will remain constant for till the time I retire. But whatever I can buy in 50,000 today will not be available for 50,000 after 35 years when I retire. So I need to plan my retirement like that. So you have to take inflation also into account. And similarly for financial planning, if a person wants to buy a house, but he doesn't have the money now. Okay. So if he is planning to buy the house, now a house is not like something which you can buy just by thinking. You have to plan. So he's planning to buy a house after 5 years. Today, if the house costs 1 crore, it is not going to be 1 crore after 5 years. Obviously, the price would have changed. So when we are planning, when we are making a financial plan, we also need to keep inflation into mind. And gradually, the luxuries have become the necessities of life today. So anybody who has access to their grandparents can understand this concept very, very well. They'll keep on telling, in our generation, we did not have this. You guys are lucky. You know, so for example, cable, dish TV was not there in 1991. Today it has become a necessity. LCD TV was not there, mobile was not there, washing machine, microwaves, branded watch. Clothes were obviously there, but not branded clothes. People were not very conscious, brand conscious at that time. Bike, car, second car.
No, during 95s we had washing machine and all, right?
Washing machine was there, but
In terms of luxury, not
it was a luxury. Only very rich people would have it. Not everyone. Now it is a necessity. So even TV was there before 1991. TV came in India long time back, and even color TV came in India in 83.
Yes, ma'am.
But
Doordarshan.
only very rich people had these. But now it is a necessity. Even your maid would have this. No, even I don't know if you guys have seen the change in mobile. You know, 20 years back. 20 years back, only one person in the family had the mobile.
Yes, ma'am.
Yeah, that too, the Walkman or something.
And usually the father or the head of the family would have one mobile.
Yes.
Now everybody has a mobile. Even 16-year-old kids or even like 10-year-old kids would have mobile today, because it become a necessity.
And they have their own numbers. That is
They have their own numbers now, because this is not anymore a luxury. It is a necessity in today's time, because their classes are happening online. They need at least one device to attend to their classes, right? So things change, things become necessities. However, I should not be saying thankfully, but COVID times have told us again, told us the difference between necessities and
luxuries.
So COVID time, at least the good thing which it has done is got some senses into us to differentiate between necessities and luxuries. Anyways, so your ability to save obviously would depend on the amount you spend. If we spend only on necessities, probably we'll be able to save more money. So the other day I was reading an article. I don't remember exactly whether it was in which magazine or which newspaper it was. There is a man who said he bought his house from his own saving. That means he did not take a loan. So he said, I always knew the difference between necessity and a luxury. I never spend on luxuries. I spend on necessities. Obviously, this person was a software engineer, so earning decently well, but not everybody is able to do this. So people spend money without thinking. People spend things on luxuries, and after that they struggle for necessities. For house, for example, is a necessity for which most of us take a loan and buy it. And this person was smart enough not to spend on luxuries, and so that he could take care of his necessities in a better way. Anyways, so the more necessities we have, the lesser would be our saving, and the more necessities if we can reduce our necessities, obviously cannot be reduced, but we are like prudent about our necessities and luxuries, will be able to save more. So everything is being rising, petrol, so we don't even need to talk about it. Petrol, we don't need to talk about everybody
By
else's.
decreasing the quality.
I'm sorry. You're saying something, Akshay?
No,
Your voice comes like from a tunnel. Don't, Akshay, don't bother. We can't hear you. Akshay, don't bother. Anyways, so here you can see
Okay,
how
ma'am.
things have been
I'll
rising.
chat on the chat box.
Hello. Anyways, so inflation shrinks your purchasing power. And petrol, so we don't even need to talk. Everybody else is talking, the opposition parties especially. So loaf of bread, now it costs 35 rupees. Huh? Your Britannia brown bread costs 35 rupees, not only 29 rupees.
Ma'am, here it is 30, ma'am.
Okay. Alright.
Ma'am, see the price of petrol, ma'am, in the year 2000. It's very funny.
So projected was 148. Now at least
No, I'm talking about 2000.
2020 it was projected. See,
Yeah,
it's
148.
projected. Projected was 148. So we should be thankful that it is still less than this in
Yeah.
2021.
We are 50 rupees less than that.
Yeah. I think petrol is almost 100 rupees now.
Yes, ma'am. Yes, ma'am.
Yes, ma'am.
It has crossed 100 actually.
It's called
110.
cross 100. Yeah.
Yeah, it has 108 or something like that. I
Yeah.
guess.
So we know it was, if we can calculate the price now by multiplying it by 1.6, assuming inflation at 6%, we can calculate the price. So we should be happy that with the inflation, at least the price of petrol has not risen as much as the inflation. Anyways, jokes apart, but we know that things have been changing and the price is increasing. Even the stationery, being college students, you would have bought stationery, pen, paper, pencil, everything. Price of everything increases over a period of time. So inflation will further shrink your buying power. So what
Ma'am-
is the, yeah,
Ma'am, do we have the telephone booth concept now in India?
telephone booth concept?
Yeah.
I don't think. Ideally, we will not know. Other we can only.
No, I think so. It is completely out of
Yeah,
existence.
yeah, it's gone. Yeah.
Oh, okay.
Post box, for example, you'll still see post boxes, but
Yeah.
I don't think they are ever emptied now. Or
Ma'am, mostly post office here, as far as I know, like it is used by salaried people for opening the savings account.
salaried people for
We-
maybe I think the
we have a
people in the
savings scheme,
armed
right?
forces, maybe
Yeah.
armed forces.
Ma'am, there is
Not-
something called savings account, ma'am. We can open
Yeah,
that.
you can open yeah, in post office. Acha,
Yeah.
okay, right, okay,
Yeah.
correct. Yeah, so
EVS
post
account
office
also.
have been converted to payment banks.
You're right, ma'am.
Yeah, so they facilitate financial inclusion now. So the original concept of the or the original objective of post office is defunct,
Yeah.
because we can a few of us are sitting 1,000 kilometers apart, but we still can communicate because things have changed. And this kind of thing you could have not imagined even 5 years back. A classroom like this or course like this, you would have not imagined even 5 years back.
Yeah,
You had
because we
to-
didn't have a better connectivity back then.
Yeah.
Connectivity was there, but we didn't have.
Yeah, it was not so good. It wasn't so fast.
Yeah.
Okay. So how do you fight inflation? What are the ways of fighting inflation?
Ma'am, we have a monetary policy to implement, which we
No,
know.
but as an individual, so that is for RBI to take care. As an individual, how can you fight inflation?
We control our purchasing.
Ma'am,
Okay, that is one way.
rational purchasing.
Yeah.
Okay, so you'll be able to save more. But again, the saving is not enough because anyways
Yes,
your
ma'am.
money is eroding, no? What is the best way to fight inflation? It is to invest rather than save.
Yeah.
Yeah? So try to earn some return on your saving. And how much, what should be the minimum return you should look at? If inflation is at 6%, what is the minimum return you should look at? Hello?
Yes, ma'am.
If inflation is 6%,
Yes,
what
ma'am.
is the minimum return you should look at?
If inflation is. Ma'am, please
Rephrase? Okay, my question is, if the inflation is 6%, what is the minimum investment rate you should look at?
minimum investment rate, ma'am, at least 7%.
At least 7% or at least 6%, because we've seen
Yes, ma'am.
your
To
nominal return is, real return minus inflation. So if
Yes, sir.
inflation is 6% and you're getting less than 6%, your capital is eroding. It is becoming lesser,
Yes, ma'am.
right? But if it is 6%, your money is remaining the same. Only when it is more than 6%, you are actually being benefited
Okay.
by your investment. So inflation can be beaten only by investment at a higher rate than the inflation. So inflation can be fought only by investing. And when is the right time to invest? When should you start investing?
Now.
From the first day of your salary.
Yes, ma'am.
Don't think, let me spend my first day of salary in buying gifts for myself and my family. Good idea, noble idea. Yes, you can buy gifts for you should rather buy gifts for your family. But again,
Right.
think
Start
of
investing.
saving as well. Maybe you can't save the entire money, but save some amount of money. So there's a principle, 30, 30, 40. That means 30% of your salary should be saved and obviously invested. So the best way to beat inflation is to invest. Now, what is the difference between investing and saving? Are they the same or are they different?
Saving.
Both are interdependent.
In saving, we are just to take a part of money aside, but investing, we are increasing our savings.
Correct. So investing and saving are different in the sense that when you are saving, you are expecting that your money remains the same. So even if you are getting 6% return and the inflation rate is 6%, that is actually saving. Your money is neither increasing nor decreasing. So that is not investing. Investing is something where you are expecting you are getting a better return. You are expecting more money than you actually have invested. So that is that actually have started with. So that is what investing is. So Investopedia explains investment as an asset or item that is purchased with the hope that it will generate income or appreciate in future. Saving is, the same amount of money. You're looking at the same amount of money. So the amount of money that is left over after personal expense has been met is saving. Saving can be used to further interest in income through investment. So investing is basically creating an asset. Now, assets can be financial assets. They can also be physical assets. If you buy gold, what is it? Investing or expenditure?
Investing.
It is investing because you're buying a physical asset. That's all right, but it will appreciate in future.
In future.
Right? So buying clothes, is it expenditure or
Expenditure.
investing?
Expenditure.
Okay. But I will say if you buy one good pair for your interview, that is investing.
Ma'am,
Because you are well dressed in your interview, your chances of getting selected will improve. So in that case, you are investing and not spending. Yeah. Yes, in fact, you had something to add.
ma'am, I just got one thing stuck in my mind. What about when you're buying what to say, like the saris, the Kanjipuram saris, because it has a resale value, right?
Kanjivaram saris, I can say it is, it can be investment because there are usually heirloom saris, right?
Mm.
They're a hair and they're passed from mother to daughter. So you can say that is an investment, but only to a certain extent. You
Okay,
can't go
ma'am,
berserk to
but
buy
because
Kanjivaram saris that
yeah,
this is an
yeah,
investment.
but because in pamphlets, I have seen ads portraying that there is a resale where you can sell your used Kanjivaram saris.
I don't know if it still is the same thing because earlier these saris used to, the jari which was used was actually made of gold and silver. So you could actually burn the sari and get some amount of silver.
Yeah, that's what I think that
Yeah.
concept is in existence even now, man, because
So I
only
don't know if
few weeks back I saw a pamphlet
okay.
with an ad like that. Like not with so much details. They told like if you have any used Kanjipuram saris, like that pattu sari, what they call, like you can have a resale value or something like that. That's why.
Yeah, it used to be the case. It used to be for Banarsi saris in the north as well. Because
Okay.
when my grandmother used to say that she had some Banarsi saris and when she burnt it, she could recover some amount of gold from
Mm-mm.
that.
Okay.
So it used to be like that. So that's why these saris are very expensive. Now, even if you want to go and buy, they'll cost around 1 lakh and above and all. Right?
Mm,
Because
yes,
they
yes,
say they use real jari, which is made of a precious metal.
yes, yes, ma'am.
So earlier it used to be the case, but with inflation, I don't know how many of them use precious metal now. But in investment, we also have to look at the returns, no? So if you buy a 1 lakh Kanjivaram sari, and when you actually burn it, you get 5 grams of gold. Is it worth that investment? It is not, because 5 gram of gold would be like 25,000, and you
Yes, ma'am.
spend 1,000, 1 lakh
Yeah,
rupees for that.
yeah. It's
So
not worth
yeah.
for an investment.
So yeah, you can look at it as an investment, but yeah, when you're looking at different kind of options available, you also look at the returns.
Even ma'am, there is not a guarantee of pure gold.
Yeah. Yes. Correct. So yeah, Coimbatore is famous for those kind of no. Coimbatore is famous for cotton sarees.
Yeah, cotton products.
Okay. Fine. So gross fixed capital formation. Capital formation. How is capital formed? Capital is formed by saving. We have seen it in economics when we're looking at economics. We've seen that capital is formed by saving. Is defined as acquisition and creation of asset by producers for their own use minus disposal of produced fixed assets. The relevant assets relate to products that are intended for use in productions of other goods and service for a period of more than 1 year. The term produced assets means that only those assets that come into existence as a result of production process recognized in the national accounts are included. So this is what we have seen in when we're looking at GDP. So I think we are not confused about saving and investment. Saving, and we have understood as
Yes,
the
ma'am.
amount of money which is
That we
available
have
to us. But investing is using that money to generate more returns. So investing is a smarter way to save. So this is one error or one mistake people do is to only focus on current needs and ignore planning for future. So however, in India, we are still much better in terms of saving. If you compare yourself with Europeans and Americans, they don't save that much. But in India, we usually actually have a culture of saving.
Ma'am, usually Europe.
Hello, yeah.
Yes, ma'am. Usually because Europeans, they don't have a tendency to use a product for a longer period of time, like
Correct.
how Indians do.
Correct. Also, they have a low, huge security system there. No, if you're US, for example, if you're not working, the government pays you some unemployment benefits.
Mm-mm.
I'm not sure if you've read it in the paper these days. There are many articles that though the employment opportunities in US are opening up, but people are still not working. They don't want to work
And
because
they are pretty lazy, ma'am, actually.
no, they're lazy and they've realized that even if they don't work, they can
Government will support them.
yeah, government will support them. So, for example, they are getting around. Some of them are getting around 5,000 USD per month as unemployment benefit. So 5,000 US dollar is a huge amount
Huge
per
amount. Yes, ma'am.
US.
Yeah.
The
So very
software
huge.
engineers which go from India
Yeah.
go at a package of 60,000 USD per year.
Okay.
That translates to 5,000 USD,
Mhm.
right?
Yes,
So
ma'am.
you're working day and night and you're able to earn only 5,000. And here you don't have to work and you can earn 5,000. People are happy. They can without working. So if they go to work, maybe they'll earn an additional 1,000 or 2,000, but then they'll have to spend also to reach there and probably buy some new clothes. They're happy in taking the unemployment benefit rather to go and work. So that is the situation as of now in the US. That's why they don't want to save. So these various stages in life. So birth and education, marriage, children, then various other requirement, car, houses, children's education, children's marriage, and finally retirement. And all of these stages require money. Okay. And the more you can save, the better, or the earlier you will be able to, buy that asset. Right. So your ability to save falls due to higher demands on your income. Is your investment working hard enough for you? So these are concepts which everybody is talking these days. So if you guys are reading the newspaper, you will read it. There are many people, many financial analysts who talk about how to make your money work for you. And there are organizations also who are working on financial independence. What is financial independence? Financial independence means you don't no longer need to work for meeting
Dependent on
your
someone.
basic requirement.
Yes,
You're meeting your basic requirement. So you work for 20-25 years. You don't need to slog till 60 to meet your basic requirement. If you do the planning well, you will not have to work. So why do we work? We work to earn money to take care of our requirements, right? So if you have enough money to take care of our requirements, there is no need for us to work. So even, you guys are just going to start your career now. If you plan effectively, you can retire at the age of 45. You don't need to wait till 60. If you plan well, you invest well, you can think of retiring at 45 at a much earlier age than 60. Anyways. So all of us invest for education, marriage, vacation, car, luxuries. And so this is about money, but we also invest our time and energy in our education. So profession will help you to create or accumulate of wealth, and investment will help you nurture or preserve the wealth. So I'm sure all of you would have heard many stories of people who were very rich, and amongst your relatives also, they'll say they were very rich at one point in time, but they were not able to manage their or nurture their wealth, and today they are struggling. So you can create wealth through your profession, but by investment you'll be able to preserve it. So this is what I was telling you. So a good investment is which will just match inflation but exceed it. So I just gave you the example of investment, an investment giving you a return of 6% when the inflation is 6%. Obviously, it's not an investment. This is actually a saving, because you are not increasing your money remains the same. The only thing is that the value of the money doesn't decrease. So any good investment has to earn more money than the inflation rate. So we have seen the relationship between nominal rate and real return, nominal return and real return. Do you remember? What's the relationship between nominal return and real return?
Nominal return is the initial return, and real return means nominal return minus inflation return. Inflation.
Yeah, so nominal is what is mentioned. So when FD, when you go to the bank and open an FD, you're told that you will get 5% on your FD. That is the nominal return. But actually, if the inflation is 6%, what is your return?
Negative.
Your return is negative. So your real return is negative. Your real return is nominal return minus inflation rate.
Inflation rate.
Right? So if you're investing your money at the rate of inflation, actually you're not investing, you are just saving, because you're not getting any more money. You're only getting the money which which you have initially started with. So any good investment is an investment which gives you more than what you have, more than the inflation rate, obviously.
Yeah.
So a good investment will not just match inflation but exceed it, thus becoming a second source of income in the long run. So yeah, from the pictorial representation, you can see only if your investment can leave inflation behind, it's a good investment. Obviously, inflations are, investments go along with risk. So no risk, no return. This is one adage we hear often. So when we are choosing investment, we also need to look at the return and the risk. So risk and return are inseparable part of investing. And what is the relationship between risk and return?
Inverse.
Huh?
Risk and return direct proportion. Higher risk, higher return.
Yeah, higher risk, higher return. Right? So you have to keep that in mind. So different type of investment come with different elements of risk. And this is what we have been seeing in financial planning. When we are looking at financial planning cannot happen without you knowing the customer, because you need to also know the risk of the customer, because the investment has to be done as per the risk profile of the customer. You cannot take more risk. So should we just take the least risky investment? That is how we should do investment. Because there's risk, we should choose the least risky. Is that how we should look at investing? Hello?
Yes, ma'am.
No. Because risk and return are directly proportional.
Yes,
if you're
ma'am.
taking the least risk,
Less
obviously your
return.
return will also be the least, which obviously we don't want to do. Okay, so we'll have to, again, you can't take blatant risk. That also cannot be done. So it is important to know the risk of the customer, the risk the customer can take, and also the risk of the investment, before suggesting it for investments. So, but if done with some care and knowledge, it can reward handsomely. So we've seen risk and returns are directly proportional. If you don't take any risk, there'll be no return. In banking or in financial service, we take We take risk, but obviously we do not take blatant risk. We do some analysis to see if this risk should be taken or not. So the risks are that taken are calculated. What we take is our calculated risk. So these are some characteristics we have to look for investment. So we have to look at liquidity, risk, and return. And we have seen that there is a direct relationship. Risk and liquidity, what is the relationship? How are risk and liquidity related?
Inversely proportional. Inversely proportional.
Correct. More the liquidity, lesser the risk.
Lesser
Because
risk.
then you can quickly come out of that investment, right? Risk and return, as we have been seeing, are directly proportional. More the risk, more the return. Return and liquidity,
Inverse.
return and liquidity are inverse. So more the liquidity, lesser would be the return, and lesser the liquidity, probably better returns will get. Yeah. So liquidity, as we know, how quickly you can convert that money. So liquidity is a measure of how easily you can withdraw your money. Risk is the likelihood of an investment not fetching the expected return. Return is how much return does the investment fetch, or how much money, how much you will earn. So you when you are investing, you also have to see, is the money invested up as a part of a business as an equity, or it is lent for a for business interest, which is debt. So we have seen this is the way the company also generates capital. It can either generate it through equity, or it can generate it by taking a loan. And a combination of other factors determines the suitability of the investment. So these are, we've understood investment classes. These are three broad types of investments. You can also add a fourth one, which is gold or precious metal, and a fifth one, which is real estate. But if you look at financial assets, these are broadly covers everything. So equities, fixed income instruments, and cash. Now, what are the downside of keeping money in cash? What is the plus point and what is the downside of keeping money in as cash? Does it have all positive or does it have all negative? What was it?
In negative sense, we can say that cash can be.
Ma'am, you mean idle, ma'am?
Idle money, yeah.
Yeah, it will not earn any interest.
Correct. So if you keep money in cash, it will not earn anything. But that doesn't mean you go and invest everything, because then also there's a problem. You will not have liquidity. If you want some cash, you might have to, lose some money for converting it into cash, right? So again, you have to maintain a balance. So in financial management, nothing is right or wrong. You have to do complete analysis to see what should be the right course of action to be taken.
Rational investor.
Yeah. So it requires a lot of thinking. Investing is not just like thinking, just putting your money anywhere. You'll have to do a lot of analysis, and especially if you're doing it for a third person, for the customer, it becomes all the more important to analyze it from all point of view. So all of them have certain kind of risk. So what is the risk equity has? What is the risk equity has?
Negative. Sorry.
Anyone? What risk does equity have?
Ma'am, fall in the value of the shares.
Market risk. So equity has
Market
a
risk.
very
High
high
market.
market risk, right?
Yes, sir.
What risk does bond and fixed income instrument have?
Inflation.
Inflation is a risk, and also credit risk.
Yes, sir.
You also have a credit risk. And cash?
Risk, it can be uh, theft or it does not increase.
Cash also has a very high inflation rate risk,
Yes, ma'am.
right? Cash also has a very, very high inflation risk. And that is what is the job of a financial advisor, to bring balance to your investment. So you definitely can't keep all your money in equity, though it gives better return. You can't keep all your money in equity, but the risk, because the risk is also very high. Right. So this is what is the job of the financial advisor, to bring balance to the investment. So for most, a combination of fixed income and equities is suitable. So definitely you can't keep all your money in equity, and also you can't keep all your money in debt. You'll have to keep a balance. So both of them have some plus side and some minus, negative. So what is the negative of keeping all your money in debt instruments, for example?
If we invest all money in debt, there's a high rate of risk of inflation. So our
Correct.
real return
Yeah.
will be decreased.
Yeah, so your return will be affected if you keep
Yes, ma'am.
affected.
Maybe
If you keep
negative.
all your money in equity, in debt, your returns will be affected.
Yes.
And what is the risk of keeping your money all in equity?
If
Market risk,
Very
risk,
high market risk.
yeah.
Volatility. Keep a balance.
Volatility.
high.
Yeah, volatility, correct. So you have to you have to maintain a balance between equity and debt. So you can save on your own, but investing will require some skills, because you need to understand the market and the investment products to be able to invest well. So that's why mutual funds help us, people who are not aware of too much of nitty-gritties of the market or investment can invest through mutual fund, because the fund manager is the one person qualified to do it. So yes, we can do investment on our own, but for most of the cases, or most of the things which require a lot of money, we depend on the expert. We just don't want to do it ourselves. So what do you think about the two scenarios which are given here? So if you need to buy a car, would you build one on your own or buy from a reputed car company? What will you do? Obviously, the answer is obvious. No, you will
We are buying.
obviously buy it from a reputed person. Yeah. And similarly for a medical surgery, though in today's time, people, try to self-diagnose themselves by
Leave it to the expert.
using Google and all, but still for surgery, you will definitely go to a doctor. If you needed a medical surgery, would you experiment with your own life or leave it to the expert? So why play with your own money? So basically invest through mutual funds. So through a financial planner. So this is some logic which you can give to the customer to use your services. So why should you experiment with your hard-earned money when you can outsource it to the expert? So tell the customers to do the investment through a financial planner. So we finished with retail banking. So retail banking in today's time does not only concern retail deposits and retail loans. Retail banking in today's time also means investment planning or financial planning for the investor. And when we are looking at different kind of investments, we have seen that different kind of investments come with different elements of risk. It is important to understand the risk of each investment and obviously try to balance the risk and return. So we can have different kind of investments like equity, bonds, and cash. And when we are looking at investment, we have to look at the investment comprehensively. We just can't look at the risk or only the return. We also have to look at the liquidity. So we have to look at the risk, the return, and liquidity before choosing the right kind of investment. And one thing is missing, even the tax angle should be considered. So probably we are going to talk about more about it when we come to semester 3. But tax also should be seen, because your return are also affected by tax. More the tax, lesser would be the return. Right? So that is the key to financial planning. So by balancing your saving between different investment is the key for investment. Right? So that is about investment banking. So I hope with this, all of you would have understood the expectations the bank would have from you. So can somebody recap or what are the things the bank would want us to do?
Ma'am, please repeat your question.
My question is, we have seen retail banking, the functions of retail banking, the objective of retail banking, So when a bank recruits you, what will be the expectation of the bank from you, from people working in the bank?
That we will increase the business of the bank.
Okay, increase this. It's a very general sentence.
Okay,
Just think of a better way of putting it.
means we can increase the transactions of the bank and we can motivate the customers by investing in different securities and using the different products of the bank, so it will beneficial for the bank and for the economy.
Correct. So the bank would expect you not only to interact with the customer to do his help him with his transaction, but also manage his investment for him. So the bank also expects financial planning. You need to know the investment products and the risk associated with each investment product, because you are also expected to advise the customer about investing. Right? So don't think, again, I will say banking has changed a lot in the recent past. All the mundane transactions which were happening, or transactional banking which was happening, is being automated. So banks don't need people there, but they still recruit for people to build a relationship with customers, to handle the customers not only in terms of deposits and loan, but also investment. So you'll also be required to have knowledge on investment, and you will be also be required to advise the customer on investment. So I hope all of you understand the expectations of the bank, right? Now, it is important to understand the expectation, because when you understand the expectation, you can work accordingly. Most of the time, people are disappointed because somebody does not meet an expectation. So when you're going for an interview, you'll be interviewed to find out whether you can handle everything. It's not only about speaking with the customer, but will you be able to help the customer in his financial planning? Will be able to sell insurance or investment product to the customer? So that will be the expectation of the banks from you. In between the sessions, I'll keep on giving such inputs, because when we go for the interview, our expectation should be clear. So banking job till now, that is how we understand, or our parents understand. So our parents tell us, you must become a banker because it's a very cushy job. It is a very people respect bankers, so you should become a banker. But today's time, the work of bankers have changed. They have to work like relationship managers, where they need to understand the customer, understand his investment requirement, and advise him for that investment. So that is also one part of banking, or in today's time, probably the most important part of working in a bank, being able to sell and advise about investment products and insurance. So if you work for a bank, you'll be required to do all this. Anyways, so with that, we have finished deposit operations and retail banking and deposit operations. So we'll start with probably the
New
next topic,
topic.
which is about loans. So just give me a moment. I will just populate the presentation. Just give me a moment.
Ma'am,
Yeah.
ma'am, from now on all weekends we have 4-hour class.
Yeah.
Okay.
Was there a discussion to end the
Ma'am, no, ma'am, nothing like
well,
that. But like in the month of July, I had a talk with my counselor, and she told like it will be your course will be ending somewhere around October second week. But still, there is a confusion about the duration, and because when we inquired them about the duration, they told us it will be somewhere around 3.5 to 4 months. But I don't think so because, ma'am, what is your idea, ma'am, on that? Like, will it take
So it will
till
take,
December?
so ideally the way we are going, it should take at least twice the amount of time it takes for a normal course. So the normal course is 3.5 months. Your course should take at least 7 months. That is my take. Because we are having a fewer number of classes. For a normal batch, I have 15 classes per week. For you, from now on, we will have 8 classes per week. Earlier, we
Okay.
were having only 6 classes per week.
Ma'am, but is there a possibility? I'm just asking if there is a possibility to have a class on Friday,
Uh,
because with the duration thing, uh, like we are not little okay with it, because initially it was told 4.5 months, but now I don't know, ma'am, about that. It's little confusing for us.
Ma'am, if we have our exam,
to tell you the truth, I will not have an answer for this.
Yes, ma'am.
You'll have to talk with Sakshi.
Okay. Because
So,
because I was like we were under the impression, because okay, this course will get, and it will get over by the end of October or somewhere between November, so that at least within this month, within this year, we'll be in a new job. Okay, something like that.
so you put your concern to Sakshi,
Yes, ma'am.
because she'll be able to give you an answer. If you've seen, she's the one who plans the session. I only come and take the session.
Okay, ma'am.
So I don't have much control over how this course, how often we should have the class, or for how many classes we should have the class.
Yes, ma'am. Ma'am, so what about counselor? If we ask counselor, it's not good idea.
I think counselors also will not be able to tell you about it.
Okay, only the.
I think, yeah.
Okay, okay, ma'am.
Sakshi should be able to tell you,
Yeah,
because she's
okay.
at the center, sitting at the head office, and they are the ones who plan all these sessions. Okay, so I think she's a better person to ask.
Okay, ma'am.
So actually, this is a weekend batch. That's why it's a problem. It's not actually a problem. It suits, most of the time, these kind
Yeah,
of batches are run for working professionals.
yeah, ma'am. But if you take the slides, no, we have only hardly 18 slides left, ma'am. I think we will be able to complete if we go at this speed, I guess. Maybe by the month of November.
I have not done the calculation, and I'll not be able to give you,
Ma'am,
I should not give you of any false
yeah,
commitment, and I should
yeah.
also not try to either hurry up or, you know, slow the course. I should
Yeah,
go
you're correct,
exactly
ma'am.
as per the session plan, you know. So I will not be able to do it because I have not done the calculation of the number of hours. So we are on, as of now, we have just finished one semester. We still have 3 semesters to go. So we are in the mid of the second semester.
ma'am, maybe we have exams in this month.
This month,
Yes, ma'am.
12 and 2, 14. 1 minute, I've just opened your session plan. I'll just see how much, how many hours we need to give to this semester. Okay, so we have finished deposit products and operations. So we still have 8 plus 4, 12, 12 plus 2, 14, 14 plus 2, 16, 16 plus 4, 22. Plus 2, 2, 4, 6, 8, 8 and 6, 14. So we still have around 36 hours of content for semester 2. So 36 hours would mean 36 by 8, around
1 month most.
yeah,
Around 1 month maybe you can.
more than 1 month. So around 4,
Somewhere around
Four
1.5 months.
yeah, 4, yeah. So probably we'll do something today as well. We still have an hour to go. So what I suggest, in front, you call Sakshi up,
Yes, ma'am.
tell your concern, discuss your concern with her, and whatever she decides. But then also everybody else should also be in line, no?
Yeah, yeah. No, I'm just
Yeah.
giving my point of view.
Yeah.
But
So then it can be discussed in group. So if people are more comfortable with a class on Friday, we can have it. There might be people who are working. For example, Bindu is working. For
yes,
her
ma'am.
to attend the Friday session would not be possible. So I don't know. I can't give you an answer for this. For this, directly speak with Sakshi. Don't send a message or something. Just ask her when you can call her, and have a candid talk with her to find out what can be done best.
Thank you,
Yeah.
ma'am.
Ma'am, how can we manage when we have exams in this month?
Okay, another issue. When do you have your exams?
Ma'am, maybe from the 22nd September.
But our class will be only on the weekend, no?
Yes,
Will you
ma'am.
have
But
exams on the weekend?
yes, ma'am.
On the weekend also you have exams.
Ma'am, from at least Saturday we also have exam.
So again, if both of you have an exam, we'll do something. We'll probably adjust the timing. So we might not have the class from then 2 o'clock. We can have it later or cancel. Again, Sakshi
No.
will be able to answer this question.
Okay.
So don't worry about it. We for example, for one of the batches I was taking, people had exams and we canceled their classes for 15 days. So we also try to manage.
Okay, ma'am.
So we've done this. In case you have any issue like that, it's best to discuss.
Okay, ma'am.
Discuss with Sakshi. She'll find a solution for it.
Okay, ma'am.
So let us start with a new topic. So we have seen retail products, and I hope all of you are familiar with the retail products or the liability products for the bank. So after seeing the liability products for the bank, Let us see the asset products. So what will be the asset products for the bank? What will be the asset products?
Loan.
Loans. So all kind of loans are asset products for the bank. And this is the main function of the bank, to borrow and to lend. So they borrow through deposit products and they lend through the asset products. So in this session, we are going to learn about different kind of loans. Loans can be secured or unsecured. We'll understand some terms related to loans. We'll understand different type of charges a bank can make to secure the loan, and what is the documentation in loan proposal. So before we start, can you tell me how will you classify loans? How will you know if the loan is a secure loan or an unsecured loan? How will you know that?
When there's a means security, we have, if the loans are means they have some security, then we consider they are the secured loans. And if they doesn't have any security, we can say that they are unsecured.
Correct.
Collateral.
Yeah, correct. So if a loan has a collateral means asset of equal value, then it's a secure loan. And if there is no collateral, it's an unsecured loan. So what are the different kind of collaterals you can have? What are the assets you can have for a loan? For making the loan?
House.
I'm sorry, house. Okay.
Bonds, government bonds.
Okay, financial securities, correct?
Yes, ma'am.
Mhm.
Real estate.
Real estate, car. All
Car,
these
gold.
are, all these are securities. You can take loan against these securities. And unsecured loans are obviously loans which are given without any kind of physical security. So can you name some of the unsecured loans?
Educational loan.
Correct. And personal loan.
Yes, ma'am.
Credit card. Credit card is the most popular type of unsecured loan. So a loan or advance means on security of assets, the market value of which is not at any time less than amount of such loan or advance is a secured loan. In case the market value of the asset is less than the loan, what would be the repercussion? If the market value of the loan, if the market value of the asset backing the loan is less than the loan amount,
it will be unsecured.
It is like kind of unsecured because you'll not be able to recover your money by selling the asset. So why do you take an asset? You take the asset so that you can sell it off to recover the money. If the asset is not able to recover the money, is not able to get the money to fulfill the loan, then obviously it is not fully secured. And we have seen unsecured loans, a loan or advance which is not secured or which does not have any security backing it or any asset backing is unsecured. So loan and advances are of nature of bonds or other fixed income debt instruments. So we have seen we can go and take a loan from the bank. The bank can take a loan from us. And also a company can take a loan from us. So the company can take a loan like in form of bonds or debentures. The bank takes loan from us in forms of fixed deposit. The government also takes loan. What are the instruments by which the government takes loan?
Treasury bills.
Treasury bills, correct, and government bonds. Right. So these are the ways the government takes loan. Yeah.
Ma'am,
So
municipal bonds.
Municipal bonds are also, kind of debt where the municipalities are trying to generate money.
Yes.
Oh, these are also borrowing. Yeah, correct. So secured credit-based loan products. Secured debt means that some form of collateral is pledged to ensure repayment of debt. So we've seen secured assets or secured loans are loans where you have a security backing it. In case the borrower does not pay, the bank will have the right to sell and recover the money. So debt secured by real property such as plant or equipment is a mortgage loan or advance or bond. And there are instances when a borrower might have 2 or more layers of mortgage debt outstanding with different priorities. That means he has mortgaged his house more than once. So this situation usually occurs because the borrower cannot borrow additional first mortgage debt under the existing indenture. Do you remember what is indenture? We had seen it earlier. What is indenture? Anybody remembers? Indenture? No. Indenture is the agreement between the borrower and the lender, which defines the terms of borrowing. So, second mortgage is actually not very common in India. In India, we work on one mortgage. Mortgage is specifically used for loan against real estate. So different terminology is used for different kind of assets. Mortgage is used for real estate. So in Hindi, we say girvi. So whether it is gold ornaments or it is a car or it is a house, everything is kept girvi. That is only one word we have in Hindi. But in financial terms, we use different terminology for different kind of assets. Mortgage is used specifically for real estate. So you mortgage your real estate. That means you have given the rights to the lender to sell off your asset in case you don't repay the loan. If it is gold, then we say, we use a terminology called pledge. Pledge means you'll have to go and keep the gold with the bank. If you want to take a gold loan, you'll have to keep the gold with the bank. So for gold loans, we use pledge. For car, we use the terminology hypothecation. Hypothecation. Hypothecation means you will have the car, your physical possession of the car will be with you, but the bank will have the right to go and sell. So we use different terminology for different kind of
Can
assets.
you spell that hypothecation?
HY, I will write it down because if I spell it, probably I'll go wrong. Just a minute. We will see it earlier, you don't need to write it, but anyway, since you've asked. So hypothecation. Hypothecation. Okay. So pledge. Mortgage and hypothecation. Now these terminology are used for different kind of asset. Pledge is for when you keep your asset with the bank. Mortgage is for real estate. Hypothecation is when you have the asset, but the borrower has the right, but the lender has the right to sell it. So unsecured credit-based loan products. Unsecured is basically loan which are not secured by any asset. Now, why will the bank give a loan which is not secured? Why will a bank give a loan which is not secured?
To earn high
Because,
interest.
That is okay, but the risk is also very high, no? What logic or what justification the bank will take to give
For the
unsecured loan?
development of the economy to
No,
provide.
no.
ma'am, can you repeat your question once again?
My question is, what justification will the bank take for an unsecured loan? So why should a bank give an unsecured loan? So yeah, sometimes you're right in the sense that sometimes there might be a compulsion from the government. So for example,
For the development of some sector.
the mudra loan, which is an unsecured loan given to businessmen, first time starters for startup. So mudra loan is an unsecured loan which the government has asked the banks to give. So they will have to necessarily give it without any security. But what is the other justification the bank will use to give a unsecured loan? It is on the slide. If you pay attention, you can find the answer on the slide.
Ma'am, is it with regard to the interest rate or something?
No, it is based on credit
Finance.
history of the customer. Credit based loan. You know, so unsecured loan is not given to anyone, just like that. So if you go to the bank and say, give me a credit card, will the bank give you?
No,
No, the bank will not give you.
like the
But
credit
once you
available.
start working and you work for a good organization, banks will be after you to take a credit card. So for unsecured loan, bank rely on the credit history or the background of the customer, right? So or the credit rating. So we have seen credit rating. Do you guys remember credit rating? And where did we see it? We saw credit rating somewhere.
Yes, ma'am. Credit rating. How
Where
much?
did we see?
How much you are capable in, ma'am, in current account.
Yeah, current account also
Account
we had seen it somewhere else
Yes,
as
ma'am.
well. We had seen in the when a company is trying to raise capital via
Credit
loan.
rating. Yes, ma'am.
Via loan. In that case, the
Bank check its credit rating.
there will be a credit rating done, which will tell the ability of the company to pay back the debt. You know?
Ma'am, in financial
Similarly,
analysis.
you have. I'm sorry.
Financial ratios.
Yeah. So you have credit rating or credit scores even for individuals. So unsecured loans are usually given based on the credit rating of the individuals. So unsecured loans are loans where there is no collateral. Unsecured debts like secured debt come in several different layers of level of claim against the asset. This is very technical. Basically, it means how the banks will recover debt. So different creditors have different claims. So it becomes difficult. Obviously, unsecured debt becomes difficult to recover because you do not have an asset which you can straight away sell and recover the money. So repo or repurchase agreement is a agreement between
RBI and the
RBI and the bank. So the borrowing on the repo is not actually unsecured, it is secured. So when the bank goes and borrows from RBI for short term, so RBI does not lend like that. It says to keep securities on which I will give you a loan. So single most important source of financing for government security dealers. Repo rates are generally lower than bank rates since they are secured lending transactions. Okay, so repo is lending on securities. So we have seen that the government, the bank, has also invests, right? So government bank buys some securities. So repo transaction is done on the security the security of these kind of financial securities. So collateralized loan backed by acceptable securities like T-bills, T-bonds, and commercial papers. Now, what are T-bills and T-bonds?
Treasury bills.
Treasury bills and treasury bond, which is the borrowing by the government. Now, the borrowing by the government is more secured. Therefore, the lender is also keen to lend on these kind of securities. So if I go and take, if you take a security issued by me, nobody will lend you because I will not have that kind of credibility in the market, So the borrowing is done, the lending is done not on the security of the borrower, but on the security of these kind of assets. So these are acceptable securities are highly liquid and they have low credit risk, which means what? Highly liquid would mean what?
And convertible into cash easily.
They will be able to convert it to cash easily, and a low credit risk would mean
low credit risk.
the money will be, I
Loan.
mean,
That would mean the borrower will return the money.
yeah,
Yes.
return the money soon.
Yes, ma'am.
There's a very high probability of the borrower returning the money in time.
Nine.
So here party A or the borrower owns the security, needs cash to pay for these securities. Party B actually should be is cash surplus looking to lend on a secured basis. So even banks are looking at, no, banks are also looking at places to lend. That is the main business of the bank. But if it lends without any security, there's a high credit risk. So it look for people who is can borrow based on the securities. So this is what a repo transaction is. Party A sells securities to party B and agrees to repurchase those securities at a later date on an agreed price. So party A is the borrower, is called a repo investor. Party B is the lender, is called the reverse repo investor. So party A borrows cash and delivers securities, and party B lends cash and receives securities. Party B buys securities from party A, agrees to resell those securities at a later date on an agreed price. Reverse repo. Reverse actually, when party B buys securities for party A, agrees to resell those securities on a later date on an agreed price. Yeah.
Ma'am, please re-explain the above term.
So, for example, party A here, for example, has a lot of securities, but it does not have liquid cash.
Okay, ma'am.
Yeah. In that case, what will it be looking for?
We are
It will be
selling our
looking for a
security.
person who has cash,
Yes, ma'am.
right? And then it will find a person who has cash. And obviously, nobody would lend cash like that. He said, these are my securities. Please take it and give me the money.
Yes, ma'am.
Okay. So, and but this is an investment for A. So he doesn't want to, lose it. What he says is, you lend it for me to me for a certain period of time. After some time, I will come and return you the money and take the securities back.
Yes, ma'am.
So that is what it is.
Okay.
So party B buys securities from party A and agrees to resell those securities at a later date on an agreed price. That is a repo transaction. So if you have these financial securities, so these are also borrowing. So for example, T-bill is borrowing by the government. So when the government is borrowed, the government is going to pay interest on that. So in that case, who will get that coupon or that interest? Who will get that interest? Party B, no?
Yes,
Party
ma'am.
B will get the interest because as on that date, party B would be the
Owner.
actual holder, right?
Yes, ma'am.
So all cash flow, that means coupon payment on the collateral, are collected by the repo investor. On repo termination date, if borrowers fails to repay loan, lenders can sell the collateral to recover their loan and interest amounts. Reverse repo investors or lenders do not loan full value against collateral, but keep a certain margin as haircut. We know this, no? Nobody is going to, even the bank does not lend. The bank never lends the entire amount of the asset value as loan, right? And this is their earning. So, but they keep a certain margin as haircut. So this is the difference between the loan amount and the value of the collateral. And lenders protect themselves against default risk. So what is the other name for default risk? What do you know default risk as? Default risk is also known as
Market risk.
no. Default risk is not market risk.
Security risk.
No. Why nobody else is trying?
Ma'am,
What is default risk? What is the other name for default risk? That means you don't understand.
risk.
Huh?
Credit
Credit
risk.
risk. Yeah, default is the
Yes,
inability of the borrower to pay the money back. That is the credit risk.
ma'am, I thought this, but like since market risk cannot be default risk, then I thought, okay, this might be wrong.
Market risk is different. No, what is market risk? Market risk is the change in price in the market price of the security.
Mhm.
What is default? Default is not being able to pay. Same is the credit.
Okay.
So default risk is also known as credit risk.
Okay, I got your point. Defaulters. Something like that.
So obviously, the lender will take sufficient haircut to protect against the price decline in event of a forced liquidation of the collateral and by daily mark to market collateral. So the lender here is not taking the market risk. You know, if there is a decline in the market value of the security, the lender will ask the borrower to keep more securities. So for example, the lender is giving only 80% and the borrower has kept securities worth 10,000. So the borrower will give only 8,000 rupees. In case the market value of the securities falls below 10,000, the borrower will, the lender will immediately ask the borrower to keep more securities. Okay, so that is mark to market. So daily, because they don't want to take any market risk, they are anyway taking the credit risk. Or actually, if you look at, they are not taking any risk. They are neither taking default risk, because in case there is a default, they will simply sell out the securities, and they are not also taking the market risk. So they are asking the borrower to come and keep additional security as per the market value. So the lenders are marking their lending to the market. So daily marking to market collateral, requesting borrower to post more collateral when value of the existing collateral drops significantly. So do you understand this? Silence.
Yes, ma'am. Yes, ma'am.
Yes, ma'am, but can you repeat as a summary? Can you summarize it?
Yeah. So what we are saying is that in repo transaction, basically, the lender is totally risk averse. That means he doesn't want to take any risk. He is not taking any credit risk because he's not lending without any security. He's not lending without any security. It's not an unsecured lending. It's a secured lending by the security. So he's protecting himself from credit risk. The other kind of risk which can arise is market risk. Market risk is the risk of falling or change in the prices of the securities. So if the price of the securities fall, the lender is not going to take it. The lender is going to call up the borrower and ask him to keep more securities. That is what it is. So I'll just read it out again. Probably if you even don't understand, probably I'll explain again. So all cash flows on collateral are collected by the repo investors. That means all the benefits which are occurring on these securities. So basically it is what? A has bought some government securities, but he does not have cash. If he wants cash, he will have to generate cash by these government securities. Okay, but he doesn't want to, just go and sell it. So he sells it to the lender, which is investor B here, temporarily. That is why it is known as repo transaction, because whenever A has money, he will go and buy back these securities. So he's temporarily selling the securities to B. Now, when B is a registered holder, if you remember, I don't know if you guys still remember, we had seen a record date, annex dividend and all that. Do you guys remember any of that?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yeah. So if you remember, we had seen after the company will pay benefits to the people who hold the securities as on record date, right? So
Yes.
as on, so when the securities are in the name of investor B, the interest payment will happen to investor B. So that is the first sentence. All cash flow on the collateral are collected by the repo investor. On repo termination date. What is repo termination date? That's a repurchase date. A has sold the securities temporarily to B. On repo termination date, A will buy the securities back. So on repo termination date, if borrower fails to repay loan, lenders can sell the collateral to recover their loan and interest amount. And we have seen this bank also does. On repo termination day, reverse repo investors or lenders do not loan full value of collateral. That's the case for the bank also. I think I've given you example. If you want to buy a car of 5 lakhs, the bank is not going to give you the entire 5 lakhs. They're going to give you 4,80,000 maybe. Because they will keep into, they'll keep depreciation of the car into account as well. So if they go to the market, they want to sell your car, they might not be able to sell it for 5 lakhs. They will never give you the full value of car. So that happens also in the case of repo transaction, where reverse repo investor do not loan full value against collateral, but keep a certain margin as haircut, which is the difference between the loan amount and the value of the collateral. In banking, we call it margin. In financial securities, it's called a haircut.
Ma'am, here one doubt, ma'am.
Sorry?
Ma'am, one doubt.
Yeah.
Ma'am, here B is the repo investor, right?
He's the reverse repo investor. Repo investor is party A. B is reverse repo. So whenever you are lending, it is a repo, reverse repo, no? So if you look at bank transaction, when bank borrows from RBI, it is a repo transaction.
Yes.
When bank keeps their money with the with RBI, it is a reverse repo transaction. Right? Okay.
Ma'am, in the first line, a repo investor is a A.
Repo investor is A, correct.
So all the coupon payments were received by A according to first statement.
Yeah, correct. You're right on that.
So, ma'am,
1 minute.
so whatever the transaction means, when we can say that the name will not be changed in the security. That's why A receives the coupon rate interest.
The name would not be changed in the, the securities have to be kept with B. The name probably will not change.
Yes, ma'am.
Correct. Okay. Yeah. So reverse repo investors do not loan full value against collateral, but keep a certain margin and haircut that, we see it in banks as well. Lender protect themselves against default risk. I hope there's no confusion on this. How are they protected against default risk? How are they protected against default risk?
Margin or mortgage.
Collateral.
No, why mortgage? They have the securities. Yeah, they have a pledge. You can say pledge. It's not mortgage. It's not
It's a
real estate. So we will not use the word mortgage. We will use the word pledge, because pledge is used for financial security. So these
Collateral.
securities, collateral are with the lender. So the lender has the right to sell it off. So they are protected against the default risk. And also they are taking a sufficient haircut to protect against the price decline. In event of a forced liquidation, liquidation is selling it off. Liquidation, as we know, liquidity, conversion of asset into cash, liquidation would mean when you sell your assets to get cash. and of the collateral, and by daily marking to market collateral. So which requires borrowers to post more collateral when value of existing collateral drops significantly. So you understood the concept of mark to market, M2M?
Once more, ma'am.
So for example, I have given a loan of 8,000 against securities of 10,000. So my margin is 20%. So I do not give, obviously don't give the entire value of the security. I give only 20%, right? Now, if the market value of that 10,000 falls to 9,000, for example, I'm at a risk, right? I'm at a risk. So I will not take this risk. I will call up the borrower and ask him to keep more securities so that the amount I've lent is around 80%. So probably I'll ask him to keep additional 500 rupees securities so that my lending is 80%. So basically, I'm also not ready to take the market risk. In case the market price reduces, I will ask for more securities. Is it clear now, infant? Hello?
Yes, ma'am. But ma'am, so as you said, like if the value falls,
Yeah.
so what happens? What is the next stage?
Value falls, then I will ask the borrower to keep more securities with me. Okay. So for example, again, we'll take this example of 10,000 rupees. Now 10,000 rupees, the value falls to 9,000. Now when the lender is the borrower is returning me the money, he will not only return me 8,000, he will return me 8,000 plus interest, no?
Yes, ma'am.
Yes, ma'am.
Yeah. So it can be more than the market value, which is now 9,000. So in that case, as a lender, I will lose. I do not want to take that risk. So the moment the price falls significantly, I will ask him to keep more securities with me. So he has kept securities worth 10,000 and that on particular date. The value has fallen to 9,000. So I'll say keep additional securities. So the value should be 10,000. So for example, okay, let me explain to you like this 1 minute. Who has gone? Hari Prasad is gone. Okay. So somebody has kept 10,000 worth of securities with me and say he's kept 10 securities and value of each security is 1,000 rupees. Okay. Now the market value of this falls to 9,000. Right. So that means there is a probability of me making losses because I have lent, say based on that 10,000, I have lent 8,000 because I'm expecting I will also get interest, right? So now based on this 10,000, I had lent 8,000, but now the market value has become 9,000. So what I will tell the borrower, please make it 10,000 because that is my policy. I cannot lend 8,000 or 9,000 because the market value, if I've marked to market, this is my market value. The market value of security is 9,000 today. I am not going to take the risk now because this might not cover my interest. So come and keep additional security. So maybe come and keep one more security so that the value is again restored to 10,000.
10,000.
Yeah, now you understand.
Yes, ma'am.
Yes, ma'am. Yes, ma'am.
Yeah. So I'm not even ready to take the market risk. So we've seen market risk is the risk of the value of the security decreasing. The moment the value of the securities decrease, I tell the borrower to keep more securities with me so that even the market risk doesn't affect me. So here I'm not trying to take a huge amount of risk. That is what it means. So daily marking to market collateral, requiring borrowers to post more. Post means bring more collateral when value of the existing collateral drops significantly. Now is it clearer? Infant,
Yes, ma'am.
yeah.
Yes, ma'am. Yes, ma'am. Ma'am, but still, it is in words, right? So, kind
It
of,
is
we
in?
have to, since it is in words, no, we have to follow each and every word.
No, but I explained to you in figures as well, no?
Yeah, yeah, yeah. Now it's fine. Ma'am.
So basically, if I've lent again 10,000, I'm not taking any risk of 10,000 reducing. I would always want the value of the security to be 10,000. In case the market price falls, I will ask the borrower to keep more money with me. That is what it is. Yeah. So you have one night repos, overnight borrowing. So maturity equal to 1 day or overnight repo. So generally rolled over the next day on the request of the repo investor. So obviously there is a high rollover risk. So even, see, so both the lenders and borrowers have their own requirement. Now the lender has some excess cash. It is idle cash for him. And idle cash, as we know, is a loss-making proposition. So he's also looking out for opportunities. And the safely he can invest, the better will it be for him. So overnight, you're just lending it for overnight. That means next day you will get the money. And if it is government securities, anyway, it is safe, because in case you don't get the money, you can always sell off the government securities and recover the money. So they offer good opportunities for extra cash. So banks use it very often. So banks also have some extra cash. You know, they might not have it for a long term, but for a short term. But even 1 day can make a huge loss to them. So they are looking for opportunities to lend this money. And this is a very good opportunity where they can lend without any risk. So we have seen in repo transaction, there is no default risk, and also there is no market risk. So in that case, banks will, or financial institutions will, borrow and lend amongst each other based on these transactions. So overnight repo against safe government securities are excellent investment opportunities, as they are secured loans bearing low collateral prices. So at what rate you can lend obviously will be dependent on many factors. How is the quality of collateral linked with the borrowing rate? If the quality of collateral is good, the borrowing rate would be high or low? When we are talking about quality, what quality we are talking?
Means
The paper
Value of
on
the
which
asset.
it is printed, it is glossy or matte. Is that quality what you are looking at?
Ma'am,
What
the
is the
value of the
quality we are
asset.
looking at?
Value
the
of the
value
asset.
of the asset.
Value of the asset. Ma'am.
Value of asset, ma'am.
Not value, quality. Value is quantity, quality.
Quality in terms
What quality are we looking at?
means secured in terms of security.
Yeah, when we are looking at debt security,
Okay.
how do you look at what are the measure of quality of a debt security?
They are secured by government.
No,
Fixed income.
no, fixed income. These are fixed income
Oh,
securities only.
yeah,
no?
yeah. Sorry. Ma'am.
What is the quality of a debt? How do you look at the quality of a debt? You guys are not able to relate. We have just seen it. We have seen it earlier also, and we have just revised it. How do you look at the quality? So, for example, if you have to look at the quality of an electric equipment or an AC or a TV,
Then time period.
No. Time period be term. Time period will be term. How do you look at, okay, let it be. How do you look at the quality of a television? What is the measure for the quality of the television or an AC?
Uh,
Performance.
Performance you will know later, but when you go and see,
ma'am, electrical consumption means how much electricity they will consume.
Ma'am, the features of the
no, the
product.
features are a very big term. But when you go to buy an electric equipment, the first thing you look at the star, no?
Yes,
2
ma'am.
star, 3 star, 4 star, 5 star.
Okay.
So that tells you the quality of the electric equipment.
Okay, ma'am, you're talking about the
Back to
credit
that.
rating.
Yes.
Credit rating.
Yeah. Yes.
Okay.
Yeah.
Okay.
Quality. How do you know the quality?
Okay, credit rating.
Credit rating. So higher credit rating will call for higher interest rate. Is that correct? Higher credit rating will offer higher interest rate.
No, ma'am.
जोर से बोलो.
No, ma'am. Higher rating for lower interest rate.
Correct. So this correlation you guys have to form.
Okay, ma'am.
Correct. So this tells me that you have understood the concept of credit rating and the relation of risk and return. So higher credit rating would mean high risk, low risk.
Ma'am, low risk.
Yeah. High credit rating would mean low risk.
Low risk.
Low risk means lower return.
Low risk.
So if the quality of collateral is good, that means the credit rating of that instrument is high.
Yes,
Then
ma'am.
obviously the interest rate would be lesser.
Less.
Right? Term is the time period. Obviously, for more time you take the interest, more interest you for more time you take the loan, more interest has to be paid. If there is a requirement for collateral delivery, then obviously you will expect a lower interest rate. Availability of the collateral and prevailing bank rate. So people will borrow only if the bank rate is more than the repo rate. So have you done, so when we were understanding bank rate and repo rate, which rate is higher?
Ma'am, bank rate.
Bank rate.
Bank rate is higher because that is lending for a longer term.
Okay.
So
Yes,
if
ma'am,
the
for
bank
long.
rate is high, people will take repo only if the bank rate is higher than the repo rate. If the bank rate is lower, they will go and take it from the bank, or they will take it from the RBI. So repo rate is short-term lending, and it is where the bank will have to keep a collateral. So it will also depend on the prevailing bank rate. If it is not too much different, then bank will prefer to take loan at bank rate, because they do not have to keep any securities for that borrowing.
Ma'am,
Yeah.
Ma'am, can you just repeat all the 5 points in a single point? Like
Which one you have not understood?
like all the points in one line, ma'am. So
Okay, so it's like any other loan. When you are taking a loan, it is when you are giving a loan, it is dependent on many factors. First is the probability of getting it back. If the probability is more, you will lend easily. If the probability is less, you will not want to lend.
okay, so when the credit rating is higher, it means your rate of borrowing will be higher. No.
Will be higher means the returns will be less. Means amount.
Okay, let me explain to you like this. So you have two friends. One friend is true to his word. He always comes and returns you money when he asks you for. And there is another friend. He returns the money, but you're not sure if he'll return it on the day he is promised to return. Okay, so who would you lend easily?
The one who returns me on time.
Yes.
So quality of and obviously you will expect a lesser return. You're okay if he gives you only say 5% extra. But a person who You don't know will return it on time. Obviously, you'll say me, okay, if you are in dire need of money, I'll give you, but I want 10%, because I don't know whether you're going to give the money back on the day you promised or not. Right? No.
Yes, ma'am.
So better quality, lesser interest rate you'll ask.
Okay.
Right? So quality of the collateral. The better the quality, lesser interest rate. Term is the time. Collateral delivery, if you have to give the delivery, then obviously you will want to.
Ma'am, in that case, so when your credit ratings are higher, it means you will provide it for a lower interest rate.
Correct.
Yeah,
Very,
in that
very
case,
true.
will the lender, will he,
Hmm.
I mean, sorry, will the borrower, can he borrow? He'll be able to borrow more, right?
Correct. He'll be able to borrow
Mhm.
more. Correct.
That's what.
Yeah. He'll be able to borrow more. Yes. And interest rate is comparison, no? So whenever we take loan, we compare which bank is charging the least interest, and we go to the bank which is charging the least interest. So the banks will also look at people, the bank rate and the repo rate, because bank rate is also the rate at which the bank can borrow.
Yeah.
Right. So if the bank rate is and bank rate, as we had seen, the lending at bank rate is without any collateral. It's an unsecured lending. So banks would want to, if there is not a considerable amount of difference between repo rate and bank rate, they would rather borrow at bank rate than repo rate. Right. So prevailing bank rate also have is a deciding factor for the repo rate, for the repo rate transaction.
Ma'am, what about the term of repo?
Term is a time. Term is a time.
Ma'am, can you
You
explain
will
that?
obviously have to pay a higher interest rate if you're borrowing for a longer term. So if you're borrowing for overnight, or you're borrowing for 2 days, or if you're borrowing for 15 days. Infant?
Yes, ma'am. Yes, ma'am. Ma'am, I was not able to like follow the other points. That's why I'm asking you.
Term of the repo. No, so that's why I'm explaining. So term, do you understand? Term is the time
Yeah,
period
yeah,
for which
yeah,
you're
yeah.
borrowing.
Yes, ma'am.
So these are factors not only for repo, for any kind of borrowing. These are the factors.
Okay, ma'am. And what about the collateral delivery requirement?
Collateral delivery means you have to go and keep the collateral. You have not seen Harshad Mehta, no? Scam 1992.
No, I have not seen, but
No, I'll tell you. 1 minute, because there is a, not because I wanted to see you. I was just asking because there is a direct correlation there. So delivery means that when will you feel secure? When you have the actual asset with you, no, then you'll feel secure.
yeah.
But usually in banking, banks obviously are business of trust, so they trust each other. So if a bank says, please give me a repo, I have like 1,000 securities, the other bank usually does not insist on the banks coming and keeping the physical securities with them. Right? So when the transaction is easy, banks don't mind paying a little more interest. If the lending bank insists that they have to come and keep the securities with them, obviously the borrowing bank would want to pay a lesser rate of interest. That is what delivery requirement is. That delivery is to give the securities. Yeah, infant, clear or still doubt?
Yes, ma'am. And about the fourth and fifth point, ma'am, that.
Interest prevailing bank rate, so I just explained, no? Bank rate is also a way for the bank to borrow.
Okay. You
If
mean
there is
the.
a not much difference between the repo and bank rate, the bank would prefer to borrow on the bank rate because it is easier. It does not require any additional security.
Okay, ma'am.
Okay. Then availability of the collateral. So if it is easily available, then the interest rate would be lesser. But if say if the prevailing rate of interest is lower, and the collateral you have as a higher interest rate. So that is rare in the market. So obviously, this would be more sought out after collateral, and people will want to have it. So the interest rate would be less. So it's a play of demand and supply. If the supply is more, it is not something which is which will be rare, and the interest rate obviously would be normal. But if it is rare, then the interest rate paid, the interest interest rate to be paid would be lower, because this collateral is paying a higher rate of interest. So availability of the collateral in the market, if it is
Okay.
easily available, the interest rate would be different. If it is rare, the interest rate would be different.
Hi.
That is what.
Yeah.
Okay, now there is a carrying cost. We have seen that there is a carrying cost in inventory as well. So when
Yes,
you
ma'am.
carry
Carriage.
the, yeah. So for example, I have a ready-made garments showroom. So though I have stock of only 5,000 rupees, there is a carrying cost, because if I have to keep that inventory, I'll have to have a guard sitting outside, for example. So there is a carrying cost. So accrued interest on collateral minus repo interest is the carry. Okay. Now accrued interest, what does accrued interest mean?
Means the interest we imposed on the asset.
Yeah. So for example, I have a security which pays 10% interest. Okay. Right. Now, and then just let me think of a way of to explain it to you. Just give me a moment. Okay. So repo interest is the rate which the borrower has to pay, no? Repo rate so that is the repo rate. Okay. Now accrued interest is what the
Borrower on.
borrower will get,
Okay.
right? So borrower has to pay interest to the person whom with him which he's entered the repo transaction, and accrued interest, because the borrower owns the security, he will get interest on it, right? So for example, the security is at 10%, or so 10%. So 1 month I've entered into a 1 month or you can say, okay, 1 month repo transaction. Okay. So 1 month repo transaction would be 10 by 12 minus the interest rate which I have to pay. So the so for ease, let us make it 12%. 12,
Ma'am.
12. I'll just explain. Okay. And the repo rate is say 5%. So that is my carry cost. Okay. For 1 month. Now, why have I divided it by 12? Why have I divided the
Because
interest
of
rate
1
by
month.
12? Because this is per annum.
Yes,
So
ma'am.
I'm calculating the cost of 1 month carry. So for 1 month, I'll get 1% interest, and I have to pay 5 by 12 is amount 4, right? 0.4. So my carry cost is 0.6. Okay.
Yes, ma'am.
Yeah.
Ma'am,
So,
in simplest
yeah.
ma'am, in simplest terms, we can say that carry is the difference.
Yeah.
Carry is the
Carry is the
difference
difference
between
between, yeah.
difference
Correct.
between the
Accrued interest
interest.
minus repo interest. Yeah.
Yes, ma'am.
So if is it a positive carry, that means accrued interest is more than repo interest. If it is a negative carry, accrued income is less than repo interest. So I think I will leave it here, but you know, I would want you to do this exercise on your own, because probably then I will know whether you have understood or not. Right. So we value of collateral. Do you understand what is value of collateral?
Yes, ma'am. Value of the asset.
Value of the total
Total
security.
asset.
So gross
Security,
price
yes,
of
ma'am.
one security into number of bonds.
Into number of
So
bonds.
the example I gave you, 10,000, where I have
Yes, ma'am.
where I have
10 rupees per
1,000 rupees bonds, and I have 10 bonds.
Okay.
So my value of collateral
Okay.
is
So
10
10,000.
into 1,000.
10,000.
Loan amount is the amount which the lender will give. We have seen that the lender will never give 100%. Otherwise, it would be 1 into value of collateral. If the lender gave 100% of the collateral, the amount would be loan amount 1 into value of collateral. That is not the case. So, for example, again, the example I gave you of 10,000 rupees, where haircut was 20%. Yeah. So
Yes,
1
ma'am.
minus
8,000 rupees.
0.2 is equal to 0.8. That means I will not give the entire 10,000 rupees. I will give only 80,000 rupees.
8,000 rupees.
Yeah, 8,000 rupees, right? So that is the loan amount.
Yes.
Yeah.
Loan amount.
Yeah. Then gross price. Now clean price is the quoted price of the collateral security, which means the market price. So quoted price of the collateral. Now gross price is clean price plus accrued interest. Now to understand this concept, you'll have to go back to the concept of cum dividend ex dividend. Do you guys remember the concept of cum dividend ex dividend?
Cumulative dividend.
What does cumulative dividend means?
Means
of dividend.
cumulative
Along with
when
dividend.
in the yes, ma'am.
It means along with dividend, right? And ex dividend mean
Excluding
without the
dividend.
dividend, है ना? So gross price of each security would be clean price, that means market price plus accrued interest, right? So let me explain to you this by this. So I have a security which pays interest on 30th June, 30th June and 31st December. Okay. Now I receive the interest on 31st December and sell the security on 1st January. I don't have any accrued interest because I've sold it on 31st. I've received interest till 31st January and then sold it on 1st of January. So I'm not entitled to any interest. But in case I sell this security on 31st March, I should receive dividend from 1st Jan to, or I should receive the interest from 1st Jan to 31st March. Because the company is not going to pay any dividend here. The company is going to pay the interest only on 30th June. And who will receive it? If the company pays interest on 30th June, who will receive it? The buyer or the seller?
The buyer.
The buyer will receive it. The seller will not receive anything from 1st January to 31st March. So when the seller sells it to the buyer, he says that you are buying it on 1st April. You know, you should get the should get the interest from 1st April to 30th June. Right? You should not get interest for this. But because you will be receiving the entire interest, give that to me. So for example, the rate of interest payable is 12%. Okay. And the market value of the security is, say, 100 rupees. Now, theoretically, at what price will it sell? On 31st March, at what price the security will sell? Can you find out? Okay. Now, how much interest will the holder get on 30th June?
Divide by 6. Ma'am,
How much?
6 rupees. 6 rupees.
Correct, 6 rupees. And how much will he get in this? Again, 6 rupees.
Again 6. Total 12.
Yeah, so 12 rupees he will get. Now, ideally, if he had held the security from 1st Jan to 31st March,
Ma'am, 3
he should
rupees.
get it for, he should get 3 rupees.
3 rupees.
No, but that will not happen because the interest would be paid only on 30th June and that would be paid to the buyer. So what the seller will do, seller will add it to the 100 rupees. So instead of selling the security for 100 rupees, the seller will sell it for 103. That means clean price plus accrued interest. Now, do you understand this?
Last line, I am not understand.
Clean price plus accrued interest. Clean price is the quoted price. Clean price is the 100 rupees here.
Yes, ma'am.
Plus the accrued interest.
Means the interest which he did not earn.
Yeah, which he will not receive. He's actually earned it.
Earn
because
but
he's
not received.
Yeah, accrued but not
Accrued,
received.
yeah. Yes, ma'am.
Accrued
earned
but not received.
Yes, ma'am.
And actually this 3 rupees interest has not accrued to the buyer.
Buyer.
Because he's bought the security only on 1st April. Okay, so that is what it is. Anyways, so try to revise it and do the numerical. Though you have the solution, try to be honest and not look at the solution. It's very easy because that will make your that will give you conceptual clarity. Okay, so just look at this. If you can do it, good. If you can't do it, no problem. We will discuss it in the next class. But try to do it. The concept would be clearer.
Okay, ma'am.
Yeah.
Yes,
Fine.
ma'am.
So we meet on Saturday next, and which is 18th, I think. 18th. In the meantime,
Yes,
try to
ma'am.
do this exercise on page number 14. Okay, 15 rather. Okay, have a great week. But please study what we have read in the class today, and we'll meet next Saturday.
Yes, ma'am.
Okay.